the market has been pretty resilient.
This has been extremely volatile, and I think investors don't really know what they're supposed to make of all of this.
In a 6-month window, I can see a lot of volatility.
Now we get whipsawed because the positioning gets really light and momentum unwinds.
The year ends up in a much stronger spot than we are right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, it's Payrolls Friday. Economists looking for the U.S. labor market to bounce back as crude is heading into the weekend after hitting multi-year highs. The war in Iran is closing out week 5, keeping investors very much on edge. The data is just around the corner.
And the question is, why are we here, right? Because the data is coming out on Good Friday. Most people are away. The stock market is closed. The bond market is remaining open as a courtesy in case this number matters significantly. People are watching the number as an understanding of just how much momentum there has been in the economy heading into what is otherwise the main story, the main driver of markets, and that is the oil shock.
We should give you your Good Friday markets guide. The equity market trading, equity futures trading until 9:15 Eastern time this morning. The bond market trading, I believe, until midday noon, 12 p.m. Eastern time. So look out for that. For the market today, for the number 65K, we're looking for a bounce back from a terrible month, negative 92K in the previous month. The tailwinds here, the end of the strikes in the healthcare sector, one, and the second, the weather gets a little bit better.
Yeah, so does that offset some of what we saw, which was a deeply negative print? Kevin Hassett, the chief economic advisor to President Trump, said that you have to look at the rolling average at the last payrolls report. So I will be looking at the rolling average. I'll also be looking at any revisions. What is a good number? I keep going back to this. How much does that matter more than, say, the unemployment rate, which ticked up last month? Do we get that ticking back down? Is there a sense that there was some sort of aberration because of those strikes, et cetera? Those are some of the key points that people could be looking for. Also, hourly wages. How much are they actually going up? As people take your advice, John, they go to their employer.
You should demand a raise.
They demand a raise. Well,
every year you should demand a raise.
Well, let's see if they actually are doing so and if they're actually getting it, and maybe that'll show up in the data.
The 3-month moving average right now is 6K. It's not a fantastic number, and it's changed dramatically over the last 12 months. We've seen a vicious negative supply shock to this labour market, so the break-even rate has come down a lot for payrolls. The unemployment rate's still around 4%, and the question I think going into this, given the shock in the Middle East and energy, how tight is this labour market right now? And what is the potential for second-order inflationary effects? So we look to wages, one, and the unemployment rate, two.
You know, the fact that you're focused on inflation, I'm focused on inflation, is different than the most of the market, which seems to think this is a growth shock. The vast majority of people keep talking, particularly in the bond market, keep talking about this as a growth shock. If there is a lot of heat in the economy, as you're pointing out, do we have to reconsider what kind of inflationary shock there is? Because guess what? People will be able to go to their employers and ask for a raise. And we've already talked about how this could potentially exacerbate the K-shape of this economy. If the upper end of the K has more power to ask for raises because they are more productive with all this new technology, does it end up adding to a stickier inflation backdrop for longer?
A lot of questions for Kevin Hassett later on this morning. The National Economic Council Director joining us around 9 p.m. Eastern Time, 9 a.m. rather, Eastern Time. So look out for that. I'm not going to be here that long. No intention of being here that long. That conversation a little bit later on this morning.
You never know.
Also focused on what's happening in the Middle East. Precisely, you never know. A French-flagged vessel making its way through the Strait of Hormuz. That's the good news this morning for the movement of energy. The bad news, an Abu Dhabi gas facility had to halt operations. Just a reality check about the hostilities still taking place across the Middle East.
And a Kuwait energy and desalination plant was also damaged just a bit in some of those strikes and with the debris falling from some of the missiles. So still damage being incurred. The French-flagged vessel being the first Western vessel to pass through the Strait of Hormuz since the conflict began. Mixed messages. This is the theme of 2026. Mixed messages when it comes to whether we're getting closer or further away from some sort of truce or understanding.
Equity futures right now in the S&P negative by 0.3% on the S&P 500. Coming up this hour, we'll catch up with Priya Misra of JPMorgan with stocks coming off 3 days of gains. Paul Sankey of Sankey Research as energy markets face increasing shortages, and Veronica Clark of Citi looking ahead to the payrolls report. We begin this hour with stocks inching lower as markets await a fresh read on the US labour market. Priya Misra of JPMorgan writing, we don't think risk markets have fully priced in the scale and length of the energy shock. Uncertain, untradeable, uncomfortable, all adjectives to describe this market. Priya, good morning. It's good to see you.
Morning.
Before we get into all the uncertainty and the discomfort, how relevant is this jobs report later on this morning?
Oh, it's very important. I mean, you have to take each payroll report in some sort of average, but there's information value there. So the information value that I'll be watching is what happens to the unemployment rate, what happens to wages, what was the state of the labor market heading into this shock? So is the underlying momentum in the economy, is that resilient? Are we still in a low higher, low fire? So I think it sort of sets the stage, heading into that shock. The other thing, I would argue that what's the amount of slack in the labor market? If we're low higher, low fire, if most of the job gains have been in the healthcare sector, which are lower income, lower wage jobs, is that slack, that the second order effect of inflation? Because, when we think about this shock, you were just talking about it, there's a growth shock, there's an inflation shock. For it to move from headline inflation into core inflation, you actually need those wages to start to pick up. So I'll be watching all these elements of slack. Can consumers, can households go and demand that higher wages because they're paying more to fill their gas? I think that's the question I'll be watching. I also think there's a bit of an asymmetry because we've had one really weak report. Before that, we had a very strong report. If we get a bit of a weak report, well, maybe then the economy is not that resilient. So I think we have to be watching that market at 8:30 as much as we all wish we were off today. I think it's an important report.
I think a lot of people share that sentiment this morning watching this programme. The drop-off we've seen in payrolls, we've seen a drop-off. By definition, it's evident.
Right.
Have we seen a corresponding increase in slack? That's what we're trying to understand. Just how tight is this labour market? And that speaks to the potential for second-order inflationary effects.
Right. I think there's some pickup in slack. I would still say that there's not a lot of slack because when we're looking at, consumer spending is okay. Consumer confidence, particularly around finding a job, is low. So I think that tells me that there's not a lot of slack. We're still watching initial claims, Challenger, all of the elements of, if the layoffs stay low, I think that tells you that the slack is not picking up a lot. But, I think to see that this is a tight labour market, particularly as, is this like 2022? I think this is what we've all been grappling with, or is this like 2008? The economy is not as weak as 2008. There isn't that much leverage. But it's not as strong as 2022. So I think as we think about the central bank reaction function, that slack question is going to be key. Watch the unemployment rate, watch wages. We do think there's some building slack. But, our base case is still we stay in the soft landing. And that's what I think might get challenged as this energy shock lasts longer.
Can we talk about the asymmetry in market positioning heading into this? It seems like every investor who comes on, every analyst says they're more worried about the growth shock than they are the inflation shock. There are a couple of potential outliers here. When you look at surveys, that seems to also be the concern. People are expecting bond yields to go lower on the heels of what ultimately will be a growth shock. How asymmetrically poised is this market to an upside surprise, to potential increase to wages, leading to stickier inflation in the core?
No, I think people may not be positioned for that sticky inflation, particularly if we see inflation expectations rising or we see wages picking up. I see your point. I mean, people want to be long, but how many are long? And that's where I think the price action in the last few weeks, month, makes people hesitant because there's fundamentals. And I think you were talking about that fundamental aspect. This is a tax on the consumer. If they can't demand higher wages, then, they're going to cut back on spending elsewhere. This is a growth shock. But then there's the inflation side. And then you look at market pricing where we were moving lockstep with oil prices. This, what we heard from the president, if we're going to escalate, oil prices go up. So I think the technicals imply that people de-risk. They de-risk on credit, they're de-risking in equities, they're also de-risking in duration. So I think they might want to be long, but they're not long enough. I would argue this week gives us a little bit of confidence that the technicals have improved. A lot of the rate move was deleveraging. I think we were fitting a narrative, to the price action. I think people buy treasuries for liquidity. We have more price-sensitive buyers. If you can't get your money out of some other asset classes, private credit, you sell treasuries, you sell public credit. And I think we put that inflation narrative on it. This week made me feel like we were not moving one for one. So I think, depending on what happens with payrolls, we've been actually now looking at backups as levels to buy. Technicals are getting better.
If people are right in the bond space, even not necessarily with positioning, but just in their sentiment that this is going to be more of a growth shock, Then why aren't we pricing that into risk markets? I'm looking at spreads right now on high-yield bonds, incredibly tight. They've come back in from some of the spikes recently. You haven't seen that big of a drawdown from some of the record highs that we've seen in equity markets. Feels like there's a disconnect.
There is. I think there's a disconnect here with the risk complex saying the fundamentals are strong, and that's why payrolls is important. And this is short-lived. I think we've been also focused on the off-ramp. I would say we should also think about the end state. Then there's an assumption that when the off-ramp is taken by both sides, this is not just a one-sided off-ramp, that we get back to where we were in February. And I think if the market starts to focus on what's that end state, is this tolls? Does the Strait of Hormuz only open with Iran controlling it, or Iran and some friendly countries? Well, then the end state of oil is $90, $100 oil price. I think then the market wakes up to this, the risk complex, wakes up to this could be a growth shock. On credit, I'm glad you brought that up. I think with credit, we've been struggling. Spreads are still very tight. We've been de-risking. They widened a little bit. That's not at levels where we would add risk. We're seeing yield-based buying, which is again an assumption that, oh, interest rates, treasuries have risen, spreads are still tight, and so I'm getting 5.5%, 6% and all in yield. And that might be an okay sentiment for buy and hold, but if we're heading into a slowdown, let alone a recession, if oil prices stay that high and the labor market slack starts to pick up, I actually think then credit spreads might be vulnerable as well. So there may be some outflows because people see returns. There may be just concern around, can company earnings hold up? So watch the earnings as the earnings come out over the next few weeks. We'll be watching for guidance. I'm not sure what guidance they can give because company executives are in the same uncertain position. But I am a little concerned that if this lasts longer and that endpoint is a little high, that all spreads, particularly high yield spreads, leverage loan spreads, I think they can widen more.
The bank's reporting in 2 weeks' time, so that's the next stop for the earnings story. Heard this a lot in fixed income, particularly from your team, that we've created value in the sovereign space of fixed income, but not in credit and risk assets more broadly.
Yeah, when they're talking about the sovereign space, they're also often talking about the 2-year yield. They're not talking about the 10-year yield because they're talking about rate hiking expectations being overblown. I'm thinking about what the forward guidance could be. I think it's just going to be a picture of a big dartboard with the CEO standing there like this, because that's essentially the forward look that we all have.
And they've got bigger problems than just this. They've had problems that predate these issues as well. Particularly, you mentioned private credit. That's something that comes up repeatedly too.
Yeah, this is going to be the key question. How do they delineate both questions around the underwriting standards during a very long credit cycle versus this one-time shock that potentially has legs?
Priya, it's good to see you. Thanks for dropping by.
Likewise.
Thanks for making time for us on this Good Friday. Priya Misra there of JPMorgan. Equity futures right now in the S&P negative by about 1/3 of 1% with an update on news worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Iran is escalating attacks across Gulf energy sites with fires hitting major facilities in Kuwait and the UAE, disrupting operations, though officials say no casualties have been reported. President Trump is warning of further strikes on Iran if it refuses peace talks. A French-linked container ship has exited the Strait of Hormuz. It appears to be the first Western vessel to transit the strait since the war began. The vessel sailed close to Iran's coast, openly announcing its country of origin before exiting past Oman. And here, Pam Bondi is out as Attorney General after an eventful tenure at the Justice Department. Recent months were marked by various political battles and controversy over the Epstein files, with Bondi facing criticism from both sides of the aisle. President Trump naming Todd Blanche as acting AG. That's your Bloomberg brief. John.
The Dow is no longer at 50K. I'm just throwing that out there for no particular reason. Yahira, thank you.
That was the jump the shark moment. I think that was it.
When the AG starts commenting on where the Dow is.
In response to Epstein files.
Right? Come on.
It's 50,000.
And I don't quote the Dow anyway.
Anyway,
that's the first time I've quoted the Dow all year.
Well, quoting Pam Bondi.
There we go. Up next on the program, ramping up attacks on Iran.
We have our eyes on key targets. If there is no deal, we are going to hit each and every one of their electric generating plants very hard. There's not a thing they could do about it.
Up next, we'll catch up with John Lieber of Eurasia Group, live from New York City this morning. Good morning. counting you down to the jobs number, about an hour and 14 minutes away. The estimates shaping up as follows. At the high end, we're looking for something close to 151. That's the high estimate. The low is negative 16K. If you want the median in our survey, it's 65,000 going into this payrolls report. As for the equity market, the cash trading closed out yesterday with the biggest weekly gain of the year so far, a 3-day winning streak on the S&P, the most powerful 3-day rally we have seen, going back some 12 months or so on the S&P 500 to May of last year, up by around 4%, 3 to 4%. Futures this morning negative by 0.25%. I found the price action yesterday really interesting. It was a wild swing. We were down about 1.5% at the lows. And I think what it exposed, what it spoke to, is what this market wants to see. And what this market wants to see is energy moving again. And this market, I think, is somewhat agnostic about who's controlling the flow of energy, because there was an article that came out, a report, that Oman and Iran was working together to formalise their control of traffic through the Strait of Hormuz. The equity market was comfortable, in fact, encouraged by that idea, and crude looked straight through it. Crude sees that as a problem, and I find that interesting.
Markets are agnostic. I thought that was exactly the right way to frame that, because ultimately, as long as you get some supplies going through, that saves the economic backdrop for that otherwise looks pretty solid in a lot of different regions. And as long as you get the supplies, people can keep doing their thing. Oil markets are saying this isn't a feasible solution, and that's what we saw overnight with more attacks on different facilities in Kuwait in particular. This is going to be the key question. What does normal look like once we're on the other side of this?
We're trying to figure that out, and just when we get to the other side. Under surveillance this morning, ramping up attacks on Iran.
We're going to hit them extremely hard over the next 2 to 3 weeks. If during this period of time no deal is made, we have our eyes on key targets. If there is no deal, we are going to hit each and every one of their electric generating plants very hard. We have not hit their oil, even though that's the easiest target of all. There's not a thing they could do about it.
So here's the latest this morning. The president escalating pressure on Iran to agree to a deal, threatening further strikes on infrastructure sites after posting a video of a destroyed bridge near the country's capital. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, this marks a widening of the U.S.'s target list as U.S. officials say that this strike against this bridge was conducted for military purposes. It is widely seen as opening the door to potentially further attacks on transportation, energy, and maybe even water infrastructure. But as you've been discussing, there really hasn't been any indication that Iran is willing to budge when it comes to their response, as Iran continues to hit energy sites in the Middle East, including overnight striking a oil refinery in Kuwait and causing a natural gas facility in the UAE to suspend operations. And while it does appear that the first Western-owned cargo ship was able to get through the Strait of Hormuz, there's also no indication that Iran is willing to let up its grip when it comes to the waterway. And as you mentioned, Iranian state media yesterday was reporting that Iran is now drafting protocol with Oman to monitor traffic in the Strait. We heard from the Iranian deputy foreign minister saying that the country thinks that these guidelines should be in place even in peacetime and that they will start to charge a toll to these ships. President Trump told Annmarie last week he doesn't think Iran should be able to do this, but the White House still maintains that it should be on allies to take charge in reopening the Strait. Yesterday, we saw more than 40 foreign ministers convene to discuss the issue, but a person familiar with the matter says that the coalition broadly agreed that the U.S. needs to make sure that there is an agreement to reopen the Strait in any potential ceasefire. John, it feels like the consensus from allies is that they're not going to deploy military assets just yet. They need to see a ceasefire in place in order to do so when it comes to the Strait of Hormuz. We could later today see a vote in the UN Security Council that could authorize the use of maybe force to reopen the Strait, but it's already reportedly getting pushback from some members, including Russia and China.
Tyler Kendall with the latest in Washington. Tyler, stay close. We're looking for further headlines out of the region. We'll keep tracking that story for you. John Lieber of Eurasia Group writing the following. The war will likely continue for at least 2 more weeks. The Strait of Hormuz will not recover to pre-war volumes at any point in April under any scenario. John joins us now for more. John, welcome to the programme. I want to focus on this key point first, which is Iran's attempt to formalise control of the Strait of Hormuz. How much success are they having currently?
Quite a bit. I think that they've demonstrated that they have more capabilities than I think the U.S. realized going into this war. They've demonstrated they can intimidate shippers and insurers at the same time that they make life pretty miserable for the Gulf states that they're attacking. and they've demonstrated the ability to toll this thing for the first time ever. So this war has, for now, fundamentally changed the rules of safe passage of naval vessels through waterways. And, we don't know how the world's going to get out of this mess. So the Europeans have a plan to put together this coalition of the willing that could help to open the Strait and cut some kind of deal with Iran. I don't think the U.S. and Israel are anywhere close to having a deal with Iran. And I don't think the U.S. has a plan for how to open the Strait except by force, which is why the troop buildup in the Middle East is so significant. Because, other than hoping for Iranian capitulation, the only other option, the options the U.S. has is leave and then and then give the Iranians a victory, or escalate this thing and take it by force. So I just don't think there's a lot of good options on the table here, and we don't know where this ends.
It's also more complicated by the fact that U.S. allies are conceding that this can't be done through military force. In fact, the French President Emmanuel Macron, I would say, was pretty sharp in the last 24 hours, pushing back quite aggressively against the White House and saying this can only be done in consultation with Iran. Are we able to bring allies along for the ride with us, John? Because at the moment, it looks like a struggle.
If we here as the U.S., then no. I think the U.S. has really alienated a lot of its traditional allies in this war. It's alienated the Gulf states who, want the U.S. to win this battle, but are the ones taking it on the chin right now. And it's going to alienate countries across Southeast Asia who are the ones taking the brunt of the economic pain. So I think the Europeans and others right now are looking for ways to end run around the United States, hoping that they can somehow get their oil and their other shipments out, food, fertilizer, et cetera, while the U.S. continues to fight this war, because they have no ability to stop Donald Trump from bombing Iran right now.
John, there's a real question around how much progress has been made in degrading Iran's capabilities. A report out yesterday about half of Iran's missile launchers still being intact. What's your sense of what's been accomplished during this conflict?
Yeah, I'm glad you brought that up, because I do think that's the key question to watch over the next couple of weeks, is how much more degradation the U.S. and Israel can do of these Iranian capabilities. So the report yesterday was that there's about 50% of their overall missiles launchers left. We think those are mostly shorter range missiles, but then they also have these vast stores of drones, some of which might be buried underground in ways that are even inaccessible to the Iranians, but could be recovered later. And I think that's a big problem for the U.S. as well, because if they end the war with so much of this Iranian equipment still intact, it's a threat to the region. It's a threat to Israel. And I don't think that's considered a victory for the U.S. So this is the key thing to watch over the next couple of weeks. If there's a significant degradation in Iran's ability to attack, then I think the U.S. can declare victory. And if not, then they probably have to press on.
John, just finally, how much domestic pressure is the president facing right now? Gasoline prices rising, not doing well in the polls, getting closer and closer to the midterms later this year.
A little bit. I'm actually, I thought that his address the other night was pretty telling, that he recognizes that he's in some political pain. His approval rating has dropped to its lowest level of his second term, but he's making the case that this war is important, that the sacrifice of the military won't be in vain, and that he's going to press on. So there's certainly a lot of indicators that would suggest he's feeling the heat. I think for now, he's still got his coalition behind him. His popularity with Republicans is as strong as it's ever been. And he probably has most Republican members in Congress who are more or less comfortable with this. We'll see where they are after they come back from their April recess. I think that's when the pressure really starts to ramp up on Trump.
John Lieber, appreciate your time, sir, as always. John Lieber there of Eurasia Group. Gasoline prices on average in this country north of $4 per gallon and rising.
Yeah, this is a reason why you're also hearing a lot of questions around how much of a shakeup there's going to be in his cabinet. You've seen the initial stages of that with Pam Bondi, but there are other potential reports as well. How do you reshape the narrative heading into the midterm elections?
Up next on the program, how many times have you heard the phrase dated Brent in the last 24 hours? We'll get into what's happening there with Paul Sankey of Sankey Research, with crude prices surging ahead of the trading holiday. From New York City, you're watching Bloomberg TV. Equity futures this morning bouncing off session lows. We're negative here by about 0.2%. We'll be trading on equity futures through to 9:15 Eastern time. The bond market wide open as well, so check it out. Yields look like this, 2s, 10s and 30s. The bond market trading until noon. Yields this morning higher by 2 basis points, 382. 10s up a basis point, 431. The jobs report 60 minutes away. This bond market in an interesting place right now because the data's actually been pretty decent. So far this week, retail sales, ADP, jobless claims super low yesterday morning.
You've seen positive economic surprise after positive economic surprise, leading to that index of surprises coming to the highest level since 2023. How many people actually care about this jobs report? And when you look at some of the surveys, no one plans on trading around it. At the same time, it is so essential to understand how much heat was in the economy heading into this, to understand whether this is a greater degree of an inflation shock or whether this truly can be a growth shock.
Things have just settled down a touch at 430 on 10s around those levels. I know it doesn't feel like it, but the equity market just posted its biggest weekly gain of the year so far on the S&P 500. And I'll stress, it certainly doesn't feel like it, does it?
No, because ultimately we've come so far. Just to give you a sense of where we are since the last payrolls report came out in early March, the S&P is only down 2.2%. It doesn't feel like that either. It feels like we've been on a roller coaster. 10-year yields are up 16 basis points. Again, how much is this the inflationary read-through rather than the right kind of upside? 2-year yields up, though, significantly more. And that, I think, is what people are looking at. What is the potential response from federal officials?
It's setting the tone for that is this. The oil market closed today, but at the close yesterday, these were the closing prices. Brent crude at 109, WTI at 111. We just had the biggest one-day move in almost a month on WTI crude, and that's closing going into a long weekend at multi-year highs.
Yeah, and when you take a look at further out in the curve, you can also see it creeping higher. People are expecting oil prices to remain higher for longer as a true physical shortage takes place in Southeast Asia and potentially heading toward the European continent.
Who's next? That's the big question on our radar this morning. President Trump threatening Iran with more attacks on the country's infrastructure. Trump posting a video of a destroyed bridge near Tehran, saying there would be, quote, much more to follow if Iran doesn't agree to a deal. Elsewhere, a French-owned container ship making a successful pass through the Strait of Hormuz on Thursday. The passage appearing to mark the first time a Western vessel has transited the choke point since the war began. And finally, to Lisa's point, the EU facing a potential major energy shock due to impacts from the war. The Energy Commissioner telling the Financial Times that Europe is preparing for the worst-case scenarios, including rationing and releasing more oil from emergency reserves.
Yeah, that official, Dan Jorgensen, telling the FT this will be a long crisis. Energy prices will be higher for a very long time, saying that critical products could be also in short supply and that it will become even worse in weeks to come. We were speaking with analysts in the past week talking about how by the summer, if there isn't free flow of oil and jet fuel in particular, there is going to be that rationing that we were reading about. And a question, are we going to see pandemic-era disruptions to activity, business activity, that don't have to do with the price and demand destruction, but have to do with the inability to actually get supplies to engage in commerce?
We're discussing the potential risk here. This is the reality in Asia right now. There are certain governments for government workers who have introduced a 4-day working week. Indonesia has started to ration fuel. So when the Australian Prime Minister comes out and says, think about getting the train, the tram, and don't use the car to go to work, they're this close to telling you, stop using the car. You have to use the train or tram to get to work.
In Thailand, in Bangladesh, you see pictures of people lining up for hours to get a liter of petrol, and questions, ride shares, questions around delivery, questions around tourism, and people actually getting there because some of these planes don't have the jet fuel and the prices are going up. So the compounding effect in these nations is sort of a warning shot for what will happen to other regions should this be a prolonged shock.
Let's focus on the physical stress in the energy market. Pressure building on energy markets worldwide. WTI coming off the back of an 11% surge on Thursday as attacks in Iran press on. Paul Sankey of Sankey Research writing every single week now is a week of global shortage. Paul joins us now for more. Paul, good morning. Good to see you, sir.
Hey.
Physical stress. I don't think I've heard the phrase dated Brent so many times as I have done in the last 24 hours. Just walk us through that and what you saw playing out yesterday in the physical market.
Right, so the future price of Brent is set for future delivery, obviously, but then you actually can trade the physical cargo as it's available for a relatively short window. And what we saw yesterday was just an extraordinary premium that was paid for a physical cargo today, which tells you that there's extreme physical stress in the market, unprecedented, something like we've never ever seen. Over $150 Brent, I think that one cleared for Mike. You would probably actually know the exact number, John. But the other thing that's going on here is that you have this extraordinary tanker shortage, obviously, because of the tankers that are trapped behind the Strait. And as a result, what you're seeing is $10 to $20 a barrel to move crude. So we're having some quite weird effects here. We've talked about the WTI discount. You're at a situation where US refining is absolutely maxed out. And with a shortage of tankers and very expensive tankers, we're not seeing perhaps as much export from the US as prices would suggest. So there's a lot of tensions and outright shortages that you've referred to that are kind of breaking through the market, if you want.
Can we just focus on that word shortages? There's a big focus, of course, on demand destruction, but this isn't necessarily about not being able to afford a particular oil product. This is about not finding it, not having access to it. Where are you seeing that more acutely at the moment?
Well, that's a function of just stopping the straits and then going 4 weeks. So therefore, the tankers have stopped arriving as of this week, and that's where the shortages show up. That's why we're saying every day from now is just an incremental shortage. And then you have to add 4 weeks for all the tankers to restart and then actually reach their destination. So you're going to see absolutely physical shortages in Asia. There's no question about that. And then, of course, you've got those such as the Chinese that are still accessing oil, LNG, reselling some of it, interestingly enough. But the Chinese also banned exports of products. They were a major supplier into Asian markets. So what you're seeing here is diesel, jet fuel, over $250 a barrel in Singapore. And, you know, that's going to obviously have an enormous negative economic impact. The interesting thing here, Mark, in terms of physical shortages is this time we have physical shortages. In Russia, Ukraine, it was a buyer's strike. In COVID, it was a buyer's strike. This time you can't buy it if you want it, or you've got to pay enormous amounts of money for it. So we think that the Taiwanese will be able to buy the LNG they need. You know, we think the Singaporeans will access energy. But, you know, what happens in Pakistan, what happens in Vietnam, what happens in Bangladesh is very, very concerning indeed.
It's sort of split into the haves and the have-nots of nations, the ones that can actually afford to pay for it, the ones that can't and are now suffering the shortages. In Southeast Asia, there are quite a number of those countries. I'm just wondering if you have a map of the physical shortages spreading, not like unlike the pandemic, but spreading in terms of locations, places that have stockpiles that can release SPR and how long it'll take to unwind. How close is Europe, for example, of joining Southeast Asia in actual physical shortages?
Very, and I think, you know, the concern here is that you've also announced more or less a 3 million barrel a day emergency release into the market, and we're still seeing, you know, paper Brent alone at over 110. So, you know, the idea that we're going to burn through this oil that's being emergency released is, you know, now as each day goes on, and as the president's implied that will be at least 2 to 3 more weeks before anything settles down, you're going to actually burn through your emergency stocks, and then you're going to have a really nasty decision as to whether you keep an emergency stock or whether you just burn through the whole lot. The basic forecasts show that you're going to draw down OECD inventories by about 1 billion barrels over the next 60 to 90 days, which is completely unprecedented and would imply, whereas the futures market is saying $70 oil, bizarrely, the level of stock drawdown speaks to 150 or above on the regression of price versus inventory. And you know, it's just one of those anomalies of the market that the futures market is so resolutely not reflecting what's happening today in Brent, presumably because of the assumption of major demand destruction and the potential for some barrels to escape, such as we saw. In fact, the overnight news, John, is a couple of tankers made it through as well today. How
much are U.S. producers and other producers ramping up production and actually getting them out on the seas to help meet this demand? How much could it be a supply-driven response as much as demand destruction?
Yeah, I mean, we've seen a spike in U.S. exports, but nothing like what you would have thought given the price environment. And the other counterintuitive thing is that U.S. inventories are actually rising of crude. And that's what's telling me that the U.S. refiners are maxed out and the tankers are either not available or too expensive. It's the only reason I could think why you would be building inventory in the U.S. The other strange thing was that, well, not really strange, but the real fact is that only about half of the SPR drawdown, the American emergency release, was actually taken by refiners, which was interesting. And that's because they would have to pay back today's barrels with interest in the future, and they basically don't want to take that risk. So these are all, you know, unintended consequences and other consequences that you find as you go, you know, because this obviously is an unprecedented catastrophe for energy supply globally.
Paul, we were speaking to a guest yesterday who comes from coastal California, and we asked how much are you paying for gasoline right now? And I think he said north of $7 a gallon. I hear a lot of people, and they come on this program, particularly the equity guys, and I'm not criticizing the equity guys, but they often talk about how insulated America is on the energy front because America's a net exporter of energy. but it's about having the right crude in the right places at different times and what the refiners are set up to use. Can you just walk us through that briefly? Just give us the nuance about how much more complicated that one line is to say we're a net exporter and we're insulated from a lot of this.
Well, the global tightness is in European natural gas and Asian jet and diesel and global diesel. And for all of those, you basically would like Middle Eastern heavier, sourer crude to make in refineries. The light sweet has a lower yield of distillate. That's the US base. Domestic production is all light sweet, and it just gives you a lower cut of distillate, and distillate's what they desperately want. You've actually seen quite weak gasoline margins. There's kind of too much gasoline right now. And so they're really struggling to optimize their throughputs in order to get the right crude. And that's been severely cut off by the Hormuz crisis. The other aspect here is just raw sulfur is desperately needed, and that comes out of the Middle East. That also is hugely important and can be used in refining as well. So there's a major issue with crude qualities, and particularly with the tightness that you're seeing in distillate markets, which really is where we're having a massive problem and a massive economic problem.
Is there any scenario that you could foresee that would justify the $97.52 that the June WTI contract closed at yesterday?
For June, it's difficult to imagine why that wouldn't be higher, just because, we're throwing emergency stocks here. We've got at least 4 weeks of continued outage based on what the president is saying. You assume that the Iranians are not going to just quietly say, okay, let's pretend that never happened. You assume that the Iranians are going to extract maximum pain here until they get what they want, which presumably is the US basically to leave the region forever. And presumably some sort of control on Israel. So they're a long way from what I think they want. And it's a question of really what the Revolutionary Guard want here, not what the president's saying. The Iranian president's not a very powerful person, quite frankly. It's all about the Revolutionary Guard. And I think they're going to extract their return for what's happened here, unfortunately. So that's the biggest concern, is that nobody's asking what Iran wants and how far they'll go. And yesterday's attack on a bridge by the US, a major iconic Iranian bridge, has yielded an attack on a desalination plant in Kuwait today. So the idea that the Iranian command structure has broken down, if you actually look at it, you've got issues with the command structure in the US, with Hesketh changing out senior military leaders. And in Iran, we seem to have a very consistent pattern where they set a deadline, it's not met, and they do exactly what they said they would. That's pretty terrifying, because that tells you they have a very in place, relatively sophisticated command structure. And that was the hope, is that you would break down the command structure and then you would weaken Iran to the point that the people could rise up, and it's just not happening.
To that point, Paul, there's been a change in the language from the US administration more recently. And I'm not sure how palatable this change in the language is for many people. To bomb them back to the Stone Ages, 1. To go after the civilian infrastructure, 2. It used to be, we used to talk about this only a month ago, that they would degrade Iranian military capabilities to such an extent that the people would rise up and topple the regime. But if you're talking about the country in such a fashion, if you're doing the kind of things that we're talking about they're doing at the moment, it's going to make that harder and not easier.
How do you win hearts and minds if people are struggling to get water and energy? And that's part of the problem right now, and something that people are debating.
Paul, it's good to see you. Thanks for making time for us, sir.
Surely.
Thank you. Thank you very much. Paul Sankey there of Sankey Research. So let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara is with us for more. Hey, Yahara.
Hi, John. More than 40 U.S. allies holding a meeting to discuss reopening the Strait of Hormuz. The countries are weighing potential sanctions against Iran if the country doesn't agree to unblock the route. Notably, the U.S. did not take part in the talks. The group will meet again next week. Abu Dhabi suspending operations at its biggest natural gas processing facility after a fire. It's the second time operations at the project have been halted since the war in Iran started. The site is central to UAE gas supply and oil exports. And Blue Owl shares are down more than 40% year to date as pressure mounts on the private credit firm. Investors have been rushing for the exits, with redemption requests recently topping 20% in its flagship fund and 40% in a tech-focused vehicle. The firm has capped withdrawals at 5%. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for the update. More from Yahara in the next hour. Up next on the program, counting down to payrolls.
Even the data on the eve of the Iran conflict, people are actually very confused and uncertain. And I think that hiring rate will remain low for the foreseeable future until we figure out what is going on.
Up next, we'll catch up with Veronica Clark of Citi, live from New York. This is Bloomberg Surveillance. Live from New York City, welcome to the program. Equity futures shaping up as follows, heading into the payrolls report about 42 minutes away. Equity futures right now down by 0.2% following a three-day winning streak, the first three-day rally we've seen on the S&P since this war started. On the Nasdaq, we're down by 0.3. On the Russell, we're down by 0.4. Equity futures keep trading until 9:15 Eastern time. In the bond market, 2s, 10s and 30s, yields look like this, slightly higher by 2 basis points at the front end of the curve, 382. Settled down now off the highs of the year, which were north of 4%, by the way, after the chairman of the Federal Reserve put a bit of a dampener on rate hike expectations.
Yeah, I talked about how they're watching inflation expectations, and as long as inflation expectations seem to be in check, which based on break-even rates, they've actually gone down as this conflict has continued, at least in the longer term. That's what they're getting some comfort from, that they really are in a good position to do absolutely nothing. Let's turn to the oil market, doing nothing today because it's closed, but doing a lot yesterday. At Thursday's close, WTI closing higher by more than 11%. That's the May contract. The closer you are to physical delivery, the bigger the move and the higher the price. So-called dated Brent. So this is a cleaner read on physical delivery. Clearing supply and demand at spot. We're not talking about paper markets here. We're talking about getting a cleaner read on physical delivery. We've got a number north of 140, the high since 2008. That's real money. There are real physical shortages right now. We were just talking to Paul Sankey about that. And the difficulty right now is the countries that can afford to pay those nosebleed prices to get the petrol, to get the gasoline. Singapore is a wealthier country. Thailand and Vietnam struggling right now. And so the hit to GDP in some of the Southeast Asian countries that are most exposed, that don't have the supplies to really pay for it, are going to be severe. And people are watching for this to spread as the shortages get more severe.
The next phase of this is show me the data, the economic data and the earnings. This morning's about the data. Under surveillance this morning, counting down to payrolls.
Some people are struggling to find a job. Look at the consumer confidence labor differential. People are saying it's very difficult to find a job, right? And that's why they're not quitting. Given the data on the eve of the Iran conflict, people are actually very confused and uncertain. And I think that hiring rate will remain low for the foreseeable future until we figure out what is going on.
So here's the latest this morning. Investors are waiting the payrolls report. The median estimate in our survey calling for 65,000 jobs added in March. Veronica Clark of Citi writing risks are balanced to softer readings that would have markets pricing in more policy rate cuts. Veronica joins us now for more. Veronica, good morning.
Good morning.
Let's start with 8:30. 40 minutes away.
Yeah.
What are you expecting?
Right on consensus, also expecting 65,000. That's going to look like a stronger number relative to the 92K decline we had in February. There are some issues in that. We had a strike that was weighing on that February number. That strike has ended, so that bounce back is going to be in this March number. The most important detail is probably the unemployment rate still. It was very close to rounding to 4.5% in February. It could round to 4.5. It could stay at 4.4. We think it stays at 4.4. But overall, this should be a relatively benign number. But it is going to feel a little bit stale because this is March data. It's, we're not going to see any effects of higher oil prices.
Well, how do you expect it to change in the months to come?
Yeah, I mean, it is interesting that, this shock is hitting at a time of year when businesses start to pick up their hiring for the year. There's been a very interesting pattern in the data over the last couple years where really from about September through February, things look stable. The unemployment rate moves sideways. And then that lack of hiring that is really defining this labor market, that shows up as weaker data at the time of year you're supposed to hire people. You get new students looking for work. It's really been late summer when the unemployment rate is rising. And so, yeah, I expect to see that again this year.
Are there any clues that we can glean from the March report that gives us a sense of the willingness of some employers to ramp up their hiring, the need for employees and the tightness in the labor market?
Yeah, I mean, we'll obviously see maybe a stronger headline number. There's going to be those strike effects. Yeah, I would kind of average through all this Q1 data, and maybe we're averaging something like 30,000 payrolls, which I would actually say is around a break-even rate, so that you're kind of running stable there. But the hiring details, we get more from the JOLTS data, which we got the February JOLTS data earlier this week, there was a big drop in the hiring rate in February, and that shouldn't necessarily be so surprising. We saw that very weak February payroll number, but it was even weaker hiring than I would have expected. We're essentially at April 2020 levels for the hiring rate now. That's a very uncomfortable position to go into a new shock in.
Based on how companies have been behaving in the past couple of months, how likely is it that they'll respond to higher costs coming from commodity prices, coming to the lack of flow through the Strait of Hormuz, by just simply delaying hiring plans?
Yeah, that is my concern, and I think that's a real risk. I think that's probably how they would respond. We have very limited data so far for March. We got the jobs report from the NFIB survey yesterday. We'll get the full survey next week. Hiring plans are still very low there. We have high frequency data on job postings from Indeed.com. Those have come down in March. So yeah, I would worry in an environment where for a couple years businesses have been looking to cut labor costs by not hiring. That just gets worse this year as input costs are higher.
And then we've got to think about AI. There was a line that you used yesterday, Bramo, off the back of the Challenger Job Cuts report. The quote was as follows: companies are shifting budgets towards AI investments at the expense of jobs.
Yeah.
Are you seeing that in the data now?
Yeah, it's going to be really hard to pick out the details in the aggregate data. I think, we're relying on company anecdotes in some of these surveys. Those Challenger numbers are interesting, but I would never, base a forecast on it necessarily. In a normal month, we have to remember there are 1.7 million layoffs. Are people just going to say that that's AI related because it's a relatively friendly excuse? You're increasing productivity. But yeah, it could be a reason why businesses wouldn't be hiring at least.
Let's get to what it means for the Fed. So financial conditions have tightened.
Yep.
We've seen that play out in financial markets. The Fed, based on their guesstimate of where neutral is, slightly restrictive. They believe they're in a good place.
Yeah.
Do you believe they're in a good place?
I think for now, but I think they will be cutting later this year. Either the oil disruption is relatively short-lived enough, which that looks maybe less and less likely, and you don't get that kind of pass-through to core inflation. They're obviously watching inflation expectations, which have stayed anchored enough. But I think it is fair that this is just a very different demand backdrop than the shock we had 4 years ago. And this is not a tight enough labor market that you get those wage pressures and it doesn't become more persistent inflation. So I could see as we get to the second half of the year, maybe the pass-through hasn't been that big, or we're looking at other scenarios where the shock is even longer lived and financial conditions tighten more, and that's a negative growth implication.
I think we're all hoping that's not the case. Veronica, it's good to see you. Thank you. Veronica Clark there of Citi, looking for 65K later this morning. That incidentally also the median estimate in our survey, that number dropping at 8:30 Eastern time. That's the question for the Fed. Are they in a good place? And do they have the luxury of waiting to see what the data looks like through the summer?
And what is the indicator that they're going to look at to give them that comfort, given that these have been messy figures? We don't have a clear sense of exactly what the break-even rate. We were talking to Veronica. She said 30,000 on average is about the break-even rate. I'm looking at the composition. If it's all healthcare and a rebound from healthcare, is that a good thing? Well, we're getting sick and we're getting old and people need to take care of us. And those are a staple of the labor market that are sort of cycle independent, agnostic. We want to see a broad-based increase in hiring, and that's what I'm going to be looking for.
The Fed's uncomfortable with this new break-even rate. I can feel that with the doves. It's been such a steep, quick fall-off. And we're looking at a 3-month average of 6K that if you looked at that alone, you'd be concerned about the labor market. You look to unemployment, which should anchor your view of where slack is and what slack looks like. Is it increasing or decreasing? And it's certainly less dramatic.
It's difficult to understand this market at a time of rapid transition on multiple fronts.
Up next, on the second hour of Bloomberg Surveillance this morning, we'll catch up with Victoria Fernandez of Crossmark, Michael Collins of PGIM, Stephanie Roth of Wolfe Research, Aditya Bhave of Bank of America. The jobs report just around the corner.
We lost the plot on the underlying economic strength coming into this.
The inflation numbers, you're going to see it pretty quickly.
We are already going to see a significant impact on growth.
I think the economy is going to be okay.
I don't think we'll come out of this unscathed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now with your jobs report just around the corner. The number 30 minutes away. The scores into it look like this. Equity futures on the S&P negative by 0.2%, following a 3-day winning streak on the S&P and closing out the week on Thursday for the biggest weekly gain of the year so far. On the Nasdaq, down by 0.25%. On the Russell, negative 0.4. In the bond market, which will be trading now for the next 4 hours, yields are higher by 2 basis points. The 2-year at 381, on a 10-year this morning at 431. Yields a little bit higher there at the front end and the long end of the curve. Heading into this, and this number is where the bar is at this morning. The median estimate for us is 65K. The previous number, an ugly negative 92.
Yeah, how much we need to see a rebound in the number to understand the upside surprises in economic data that we've gotten recently as a trend, and something that does indicate that the U.S. economy has come into this shock from a relatively strong position enough to withstand it. Here are the key questions. How much does it take for this market to move off this number? Because ultimately people are watching oil prices, they're watching the headlines to understand how significant and long-lasting that oil shock is going to be. Is it asymmetrically poised to a downside surprise being incredibly negative and underscoring how much this is a growth shock, not an inflation shock?
The risk cuts both ways, and given how you described it, I think it's really important. It will help us answer a central question for the outlook. How tight is the labour market? And once you've established that, which will be somewhat of a debate, I imagine, once you've established that, the arguments around it, you can start to think about the potential for second-order inflationary effects. Do you have the potential to go and ask for a raise because the price of the pump is too high? Or does it result in so-called demand destruction? You heard Jim Zelt of Apollo sounding off there about the momentum coming into 26. And there was momentum. This was a consensus looking for a cyclical rebound and tons of tailwinds. A lot of capex coming from tech firms. We were going to see some tax refunds for individuals, and things were set to get better because the Fed had already been cutting interest rates. Do we still believe in those so-called tailwinds?
Yeah, and I know that you've been single-handedly trying to create a wage price spiral, but people are watching and seeing how much people are like Stephen Englander and not going to be asking for a raise, even though he should. Or are people going to be able to say we need to be offset for some of the higher prices that we're paying? We'll see that in the wage number. We'll see that in the unemployment number today. Does it stay at 4.4%? The headline number, kind of a mystery. Right now, it seems, though, as if most people who come on this show in the bond space are expecting this to be a hit to growth, not necessarily an increase in stickiness and inflation. So again, the asymmetric position of this market heading into this, and where the risk assets have fully priced it in. Again, we keep talking about the dissonance right now between bonds and stocks.
There's a phrase that's starting to bug me in fixed income. And you know what it is? Creating value.
Yes.
I keep hearing this phrase, we're creating value in fixed income, as bonds are sold off and yields rise towards the highs of the year. That makes me think, and we've talked about this a few times, that the pain trade here is high yields. Not necessarily the most likely trade, and you can decide which direction you think we're going to go in. That's your judgment. But the most painful trade is the one people are least positioned for. And what I hear from people in fixed income is they believe we've created value, which means that there's a bias here now to buy, regardless of what might happen next.
There was a survey, a pre-NFP non-farm payroll survey done by BMO. Vail Hartman put this out and said just 24% of respondents saw the direction of the next 15 basis point move in 10-year yields as higher. That is the lowest proportion of respondents since November 2010. Most think it is heading lower because of that growth shock, and it just highlights the asymmetric position right now.
Bond steady this morning, the equity market as well. We're down by about 0.1% now on the S&P 500. A couple of programming notes for you. So the equity market, equity futures will be trading through to 9:15 Eastern time, so another hour and 10 minutes. The bond market trading until midday, so noon, another 4 hours, let's call it. And in between, we'll be catching up with this guy right here, the National Economic Council Director, Kevin Hassett, joining the program at about 55 minutes time to get his thoughts on the labour market and this shock in the Middle East and what it means for the US economy.
Yeah, back when you spoke to him last month, or I guess the last payrolls report, he was talking about 4% GDP, and we can reach a place where you don't necessarily have incredibly high payrolls number, but that isn't dissonant with the idea of a robust economy. It is a productivity shock. How much has that been eaten away by the oil price shock? Do we have a sense yet? Has there been any kind of evidence to understand whether there is already a hit to his expectations for the year?
That conversation coming up in the next hour. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark, following the stock market's best weekly gain so far this year. Michael Collins of PGIM warning the economy may get worse before getting better. And Stephanie Roth of Wolfe Research breaking down the latest jobs report. We begin this hour as investors search for clarity heading into the long weekend. Victoria Fernandez of Crossmark Global Investments writing, unfortunately, the crystal ball is a little fuzzy crazy right now, which leaves us wanting to lean more towards risk-off positioning for our clients. Victoria joins us now for more. Victoria, good morning and welcome to the show. I want to start with payrolls at 8:30 and a question we keep leaning on. How instructive do you think this data actually is?
Yeah, good morning. I just really don't think people are going to pay as much attention to this number as they are the headlines that are coming out of the Middle East at this point in time. I think your biggest change when you guys are talking about how much of an effect will it have on the market, I think if you have a very downside surprise to this number, you might see more market reaction than if you have an upside surprise. And I'm guessing when you look over the last 12 months, you have a monthly average of around 13,000. And you guys were talking about the types of jobs that have been created. If you take healthcare jobs out, we actually have negative job growth over the last 12 months. So when I look at last month at a negative 92,000, I think what we're going to see today is maybe a larger revision to that number and then a smaller number for the month of March. And I think the market will probably shrug that off a little bit.
Victoria, then the next phase of the conversation is earnings. 2 weeks away, we'll be talking about the banks and the financials. And when we speak to the equity bulls, and you don't sound like one at the moment, but when we speak to them, they're anchored by a better outlook for earnings. Do you believe this shock in the Middle East is a threat to corporate margins?
I think it can be a shock to margins if it continues to go on for much longer. We're hearing right now, 2 to 3 weeks more is what the president said this week in his address, that's how long we're going to be there. We don't know truly what the answer is. That's where we have that fuzzy crystal ball. But if it goes on for longer, then yes, we are. Look at the ISM manufacturing report we had this week. Prices paid really moved significantly higher. At some point, that's going to flow through and hit margins. And when it does, that's when we're going to see the growth component come in. Your conversation this morning around, is it inflation? Is it growth concerns right now? Five-year break-evens are telling you that inflation expectations on the longer end are not moving higher right now, but yet you have yields that are not going tremendously lower either, which is what you would expect if there was a growth scare. So I think a lot of people are saying, look, we're in a decent position as long as we can get the situation in the Middle East settled pretty quickly and earnings should hold up. I'm not sure about this 14% earnings growth again in the first quarter, 19% earnings growth in the second quarter is what expectations say. That's a really high bar.
Victoria, you're based in Houston, which is sort of the oil heartbeat of the United States. What are the conversations like with people in the area, given the fact that this could potentially be a boon to certain companies, given the fact that the United States is an exporter of oil, versus people seeing what's happening on the ground, getting concerned about refined products and how much the U.S. can really support some of the need around the world?
Yeah, Lisa, I looked out the window when President Trump was saying buy U.S. oil to see if I could see, people jumping up and down and cheering across the street at the oil company offices. But the difference that we're seeing right now is these companies are not making major investments at this point in time. They're not saying, oh, look, the price of oil is high. Let's go start drilling more. Let's do new wells. They're not putting that investment back into the ground, I think, because there is such high uncertainty. Maybe we see that in the future, but it's not an immediate reaction right now. Yes, we've seen energy companies do better, but look, energy was actually as a sector doing better before everything happened in Iran. They were actually on an upswing. There was an uptrend in that sector when you looked at the technical components. So they were already doing pretty well. This can be a short-term bump to them, but I don't see at this point in time that it's making a long-term shift in expectations for oil companies. That can change quickly if we do start to see some of the companies really get orders, additional orders. Cheniere's a perfect example when you're looking at natural gas too. That is an area where I think maybe we see it pick up in terms of U.S. purchases.
What does it mean right now, Victoria, to be risk off or to go to safer investments, given the multifaceted risks facing markets, whether it's growth shock or inflation?
Yeah, our clients want to know, does that mean we go to cash? No, the answer is do not go to cash, right? But I do agree that you could get caught in a trap of saying, well, let's just go all in on fixed income at higher yields. Obviously, I manage some taxable fixed income strategies. So I do think there's some buying opportunities in some of the fixed income areas. But similar to equities, you've got to do that high quality portfolio right now. On the equity side, we have more of a lean towards value, towards dividend strategies. On the fixed income income side, it's high quality. We've seen investment grade spreads year to date go out about 11, 12 basis points on average. High yield has widened out about 65 basis points on average. So to us, it's going high quality, sticking to those companies with strong balance sheets.
Victoria, just a final word on energy. Lisa asked you about it. What's the energy opportunity? We've had such a big rally in some of the refiners here in the United States. Where is the opportunity, if there is one left?
Yeah, that's the question. Is there one left? And I think actually, and what we're doing with some of our clients, you can trim some of those names that have done really well, but keep that exposure because I think there is still more upside. That uptrend is still intact. Use any pullbacks in energy to add to positions.
Victoria, good to see you. As always, Victoria Fernandez there of Crossmark Global Investments. The supply response is really, really important. The physical market's demanding one. The long end of the futures curve is not encouraging one. And that's the dynamic we've got at the moment.
And the fact that the U.S. is already pumping 13 million barrels a day. So this already is coming from a pretty high level. Questions also about the frictions right now between the pumped goods and the amount that refineries can actually refine to get out there. So there are a lot of different moving pieces before some of these oil executives say, now's the time to drill, baby, drill.
Futures right now in the S&P negative by just 0.2%, down by 0.2. Going into this payrolls report about 20 minutes away. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Iran is escalating attacks across Gulf energy sites with fires hitting major facilities in Kuwait and the UAE, disrupting operations, though officials say no casualties have been reported. President Trump is warning of further strikes on Iran if it refuses peace talks. EU officials are warning that Europe faces a prolonged energy crisis as the Middle East conflict disrupts supply and spikes prices. The FT reporting that Brussels is weighing emergency steps, including fuel rationing and tapping oil reserves, though it says the bloc is not facing a supply crisis just yet. And the Trump administration set to impose tariffs of as much as 100% on certain imported medicines as President Trump ramps up pressure on the drug makers to manufacture in the U.S. Tariffs on imports from major economies that cut deals with the White House will be capped at 15%. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. More from Yahara later this morning. Up next on the programme, Michael Collins of PGIM warning the economy may get worse before getting better. That conversation up next in your payrolls report just moments away, 8:30 Eastern Time from New York City this morning. Good morning.
There's a bit of an asymmetry because we've had one really weak report. Before that, we had a very strong report. If we get a bit of a weak report, well, maybe then the economy is not that resilient. So I think we have to be watching that market at 8:30 as much as we all wish we were off today. I think it's an important report.
We love being here, Priya. What are you talking about? Come on. Priya Misra there of JPMorgan. It's a strange one. It happens every few years. You have a payrolls report on a Good Friday. A happy Easter to you all. To those who celebrate on the long weekend. The payrolls report about 14 minutes away, 8:30 Eastern Time. Equity futures are trading, the bond market as well. Talked about this a few times. If you're just joining us, equity futures trading for the next 60 minutes or so. The bond market trading through to noon. Equity futures on the S&P this morning down by 0.2%. The Nasdaq down by 0.3. We've had quite a powerful three-day rally on the S&P 500, the strongest going back to May of last year. We just put up the best weekly gain of the year so far on the S&P. In the bond market, we've backed away from the highs of the year on 2s and on 10s. On 2s, it was north of 4% in the past few weeks. On 10s, very close to 450. On 10s this morning, 431. Yields up by a single basis point.
With a lot of bond investors looking to buy, and I think that this is interesting, poised for a further rally because this shock is perceived as a growth shock, even though the economic data has been really positive heading into this. Just how much value has been unlocked, John? That's the key question I want to ask you.
Value has been created. We've heard it so many times, haven't we?
I'm going to troll you so well with that.
You know, they said the same thing about the equity market. The outlook for earnings is good. There's an opportunity. Value has been created. Multiple compression has arrived.
People believe that ultimately this will end at the end of the year, to quote what we heard yesterday from Jim Zelter of Apollo. September, October, we'll be looking back toward an economy that's robust. It'll be in the rearview mirror. You talk to people in the commodity space who are under their seats, biting their nails. It's something of a different story.
Yeah, the conversation we often have, I think, in the equity market is the potential for demand destruction. Never mind the potential. It's real. It's happening right now. You can see it in Asia with certain governments introducing a 4-day work week. You can see it in places like Indonesia, rationing fuel. You can see it in other nations across Asia as well. And there's a fear in a commodity market. And if you're in equity land, it's an anticipatory asset class. Maybe you're looking through that. You're welcome to. But there's a fear in the commodity market that Europe might be next. And that's a problem.
Which, especially given the fact that people are talking already about rationing. Key question for the U.S. market is, A, how insulated is it from the global market should there be a slowdown based on actual physical shortages? That's number one. Number two, how sensitive is the consumer based on what they're getting from their paycheck, their belief in getting a new job, and just how much they can ask for a raise when they have their annual discussion with their manager? So these are the questions that a lot of people are trying to answer, glean signals from the data that we're getting in just about 12 minutes' time.
Here's another view on things from Michael Collins of PGIM Fixed Income. He writes the following: the fragile balance in the US labour market is at risk. Goes on to say, my instinct is telling me that economic and market conditions will get worse before they get better. Mike joins us now for more. Mike, good morning and welcome. You're going to be with us through the Payrolls report. What is underpinning your instinct right now that tells you that at the moment? What are you looking at? What's on your dashboard? What guides you?
Yeah, you know, Jonathan, I'm typically a pretty optimistic guy, especially for a bond investor. But, you know, I'm talking to our economics and geopolitical teams, PGIM, and, you know, we're looking at the Iranian situation. Basically, there's two outcomes, right? One is that things get a lot worse. And two is that we kind of have some really watered down ceasefire where things basically go back to where they were before we started bombing them. And both of those are bad outcomes, right? I mean, to see through this as a really positive outcome for the global markets, at least in the near term, think of, you know, maybe through the rest of this year, is really a challenge. You know, normally I'm here saying, listen, we are buyers on dips, right? Because the Fed will come to the rescue if things really get ugly. But the Fed is not in a good place right now. They're in a terrible place, right? They really can't cut rates because of the inflationary concerns. Stagflation is the worst outcome generally for markets because the economy weakens, inflation stays high, and central banks cannot come to the rescue. Rates go up, curves flatten like they have. This is not a good environment for risk assets. We've had a big pop, like you've been talking about, in equities. Credit spreads have snapped tighter in the last couple of days. I mean, I'm thinking, hey, it's a better time to sell on these rallies than it is to buy on the dips, at least for now.
So, Mike, sell what? Sell what specifically?
You know, equities on the rally, Jonathan. Sell. You know, I've been waiting for stocks to go down another 10%, and they just rallied back and recovered a decent chunk of their losses. Credit spreads were just starting to look a little juicy again, right? They had widened, you know, 30, 35%. Which is, you know, over the last, you know, handful of years, a pretty good metric to start legging in. And we've been talking about legging in at these wider levels. Then again, in the last 2 days, you know, because of this strong technical position you've been talking about in your markets, meaning yields are a lot higher, right? I mean, the high yield market has benefited from treasury yields going up and that extra spread you get from widening. So the all-in yields are higher. That brings in international buyers. It brings in U.S. insurance company and pension fund buyers and retail investors. So that's caused these spreads to come back in. So, you know, I think you fade risk assets across the board.
What is a risk asset, Michael? And I ask you this because some people are talking about duration, interest rate risk, particularly in 10 years and 30 years, is increasingly a risk asset based on this toxic mix for central bankers. Do you agree, or would you be buying long-dated bonds?
You know, Lisa, this is the age-old question about, you know, correlations between stocks and bonds. Yeah, right now, the correlation is not working for investors, right? I look every day and stock prices and bond prices are moving in the same direction. Credit spreads, which is, you know, bond parlance for risk assets, when the spreads widen, that's akin to equities going down. Credit spreads and bond yields are moving together right now. That's bad for bond investors because as a bond investor, you own both, right? You own the interest rate risk and you own the credit risk. So you don't want them positively correlated. But those periods tend to be short-lived. We looked at centuries of this relationship, Lisa, right? And on average, there is no correlation between risk assets or, say, stocks and bonds. It turns positive during rising inflationary periods, like it did right after COVID. Remember, 2022 was like the worst case scenario for asset allocators because stocks and bonds both got clobbered. That was a scary rising inflationary environment. Right now, we're getting a little bit of a whiff of that as well. But one thing we do know, in the big downturns, if this labor market continues to look fragile and continues to weaken, and you do actually see demand destruction, which I think is still probably our base case here, more demand destruction, you see the economy weaken, you will see that correlation shift. Right? You have a Fed that, is changing leadership, and you have a president and a Treasury secretary and an incoming Fed chair who all want rates to be a lot lower, and they will be looking for excuses to cut rates, and a weak economy is a great one for them.
So we're 7 minutes away from the non-farm payrolls report for the month of March. Could this be the tipping point where people understand this more as a growth shock rather than something that could fuel a prolonged bout of inflation?
Yeah, I mean, unless it's a gigantic, negative number, Lisa, I'm taking this with a grain of salt. I think it's too early in this, war period to really glean a lot of information from today's monthly jobs reports. I mean, we got the JOLTS number the other day, and that was pretty telling, right? There's this indicator, jobs plentiful minus jobs hard to get, and that is pointing really down, meaning people are not able to get jobs. Increasingly, there's not a lot of jobs available. Companies, when they see this level of uncertainty geopolitically, they pull back on hiring, they pull back on capital investment, unless you're in the defense or energy industries, right? And that's one of the reasons, we'll continue to see decent U.S. Growth at least, but that's typically a weaker environment. So I think that, kind of the direction we're heading.
Mike, what time's the tea time?
Yeah, not today, Jonathan. Unfortunately, it's a holy day, right? I mean, my mother's probably already upset that I'm even working today.
Of course. Mine too, by the way. Mike, it's good to see you. You're going to stick with us. Michael Collins there of PGIM Fixed Income. Mike's going to be with us into this jobs report in just a moment. The president is already posting and on social media with this statement: with a little more time, we can easily open the Strait of Hormuz, take the oil, and make a fortune.
What this signifies to me is how much he's watching some of the response that's coming from both markets, from allies, as well as from people within the Republican Party, concerns about how the war is going and trying to portray a better scenario, a better outcome. What this market is looking for is understanding how long this goes on and how big a hit this is going to be to growth, potentially, should oil prices remain high.
It's been such a confusing week, hasn't it?
It's been incredibly
Open the
confusing.
Strait or else. You open the Strait, we don't need to open the Strait. Open the Strait or else. Give us more time, we'll open the Strait. It's been back and forth all week.
If this continues, you're going to turn on Bloomberg Surveillance and you're going to get a roulette wheel with all the different potential parameters, and we'll just spin it and we'll figure out what the narrative of the day will be.
I think I'll be playing golf with Mike, to be honest with you.
Well, yeah, probably. That's
Coming up on the programme, we're getting the payrolls report. Mike Collins is going to be back with us. Stephanie Roth of Wolfe Research joins us as well, together with Mike McKee, and then later, the NEC director. We'll be catching up with Kevin Hassett at 9 a.m. Eastern Time from New York City. Payrolls up next. The jobs report is just seconds away, and the price action into it looks like this. Equity futures on the S&P slightly negative. We're down by 0.1%, down by 0.2 on the Nasdaq. In the bond market, your 2-year, 10-year and 30-year yield look like this at the moment. Treasury yields inching just a little bit higher, up by 2 basis points on 2s to 3.82, on 10s up by 1 to 4.32. With your jobs report, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Looks like a pretty good Friday for the labor market overall. 178,000 jobs were created during the month of March. Of course, this is before the war for the most part. The unemployment rate drops to 4.3% from 4.4%. Change in private payrolls, 186,000, and the change in manufacturing payrolls, a positive 15,000. We'd seen other earlier indicators like ADP suggesting manufacturing would lose jobs. Average hourly earnings up 0.2% on the month. For the year-over-year rate, takes it to 3.5%, down from 3.8%. That's not a bad fall. Fed thinks they're kind of in a sweet spot there. Average weekly hours, 34.2. Labor force participation rate does drop a little bit to 61.9 from 62%. And the U6 rate is at 8%. That goes up from 7.9. But overall, again, 178,000 jobs created and an unemployment rate of 4.3%. So good news on the labor front. And it does give the Fed the opportunity to continue watching inflation.
Mike McKee, you give us the breakdown in just a moment. The highest estimate on the street into this print was 151. The number, 178. That's a major upside surprise. Given how noisy these numbers have been, we'll get into the noise in just a moment. But for the moment, let's take it on face value. A much better than expected payrolls report this morning. And this is the price section. Equity futures off the back of it, interesting. On the S&P, on the NASDAQ and the Russell, still slightly lower by 0.1% on both the S&P 500 and on the NASDAQ. The move is in the bond market. This is the more decisive move. At the front end of the curve, up by 7 basis points, approaching 390 again on 2s, on 10s up by 5 to 435. And we had two central questions this morning, Lisa. One, how tight is this labour market? And two, with that in mind, what is the potential for second-round inflationary effects given the shock we've just seen in the Middle East?
On the headline number, it seems like this is a really strong market. The fact that 170,000 jobs being created and the unemployment rate inching down to 4.3%, all very positive. A little bit less positive when you look at the revisions to last month, which you can see is negative 133,000. That brings the 2-month payroll net revisions to a negative 7,000. So this, again, goes to the feeling that maybe this is a little bit of evening out. The other thing is when you start to look at some of the details of what was added, healthcare workers, more than 75,000 workers that were added. If you look at employment and financial activities, it edged lower by 15,000. When you take a look at even in manufacturing, construction has shown little net change over the past 12 months. This really is a question of where the jobs are being created. Earnings haven't actually edged up as much as people expected. These are some of the aspects that people are looking at to understand the heat.
So, Mike, let's get into it. Let's talk about the heat and the bounce back. We were looking for a bounce back in healthcare because the strike had finished. The weather's improved. Weather-sensitive areas looking for an improvement there as well. Is it more than just that, Mike? More than just a one-off?
It does appear to be a little bit more than a one-off, and I think the unemployment rate is what's going to catch the Fed's attention because it's a bigger drop than even anticipated. We go from 4.441% in February down to 4.256, so more than almost 100 basis points lower on the month. And then you look at the labor force change, 396,000 fewer people into the labor force. That's not a good news story necessarily, but it does suggest that maybe there is an immigration effect finally starting to hit overall. You mentioned weather. Construction jobs were up by 26,000, a little bit less than people had anticipated, but it is a rebound from the bad weather that we saw in February. And manufacturing jobs, as I mentioned earlier, up 15,000. Information services and financial were the big losers. Financial jobs down 15,000 on the month. Lisa mentioned the education and health overall up 91,000. That's the category that's provided the most jobs overall. Leisure and hospitality, 44,000. And we do see a loss of jobs in government of 8,000. 18,000 at the federal level. There was a thought that maybe that would level out, but it hasn't yet so far. So keep an eye on the various categories and how they have changed. But I think the story of the day is while we get a bigger total number than anticipated, a significant amount, it's really the unemployment rate and the big fall there within the 4% range that is going to catch the Fed's eye, and the drop in the labor force that is causing that.
Mike McKee, thank you, sir. Mike, stay close and we'll come back to you a little bit later. So if you're just joining us, a blowout jobs report, the headline number 178. The median estimate was 65. The unemployment rate lower than expected, coming in at 4.3%. The wage number not as hot as expected. We'll spend some time on that in just a moment. This has been really noisy month to month, so take the 3-month average. That goes from the mid to low single digits to 68,000 over the last 3 months. That's your 3-month rolling average for payrolls.
Which is significantly above what we were talking about earlier this morning, which could be a potential 30,000 break-even rate, given the changing composition of the population. It's a real key question. How does the Fed handle this? Because on one hand, it points to a resilient economic backdrop, a resilient labor market. On the other hand, where is the wage growth that potentially could allow what we're seeing right now with the oil price shock to be something that's more inflationary than really a hit to growth? That still does remain the key question.
They'll keep doing something that Mohamed Al-Erin is criticizing at the moment, which is monetary policy is in a good place to wait. And you'll hear more of that. Financial conditions have tightened. We're slightly above their guesstimate of neutral, so they believe, on average, we're slightly restrictive, and they've got time to wait. And a jobs report like that gives them more time to wait to see what's going to happen following the shock in the Middle East.
I like what Michael Collins said. Actually, the Fed's in a terrible position. This is the worst position they could be in because they're facing stagflationary risks where they feel hamstrung to respond. And that ultimately is just underscored by a report that shows an economy that's doing okay, but it's heading into an oil price shock with unknown consequences. And that, again, remains to be the answer, which is the reason why you're not seeing as big of a move as you would expect based on how big of a beat this headline number was.
That 178 does not put the stag in stagflation. That's for sure. Raises a lot of questions about the momentum we've got in this economy.
Yeah, and that's the reason why some people are saying, are we underestimating the inflationary ramification from this? That still remains to be a question. That said, when you take a look at the composition of jobs, it's the reason why some people are getting comfort that it's more of a growth risk shock than it is necessarily an inflationary shock. Again, it doesn't seem like as many people are asking for raises as you seem to be suggesting, John.
True. Based on that number, let's give you an update and some reaction from Stephanie Roth of Wolfe Research. Steph, good morning.
Good morning.
What's your reaction to that? That is a stunning number.
It is a stunning number, and last month it was stunning in the opposite direction. I think we have to appreciate that there has been a tremendous amount of volatility. Some of it, of course, has to do with the strikers coming back. But even when you smooth through the data, we're probably in an environment where the trend in payrolls is somewhere between 50 and 70,000. The unemployment rate will probably bounce around between 4.3 and 4.5. And it's an economy where the labor market is largely stable. It's not picking up significantly this month, and after having significantly weakened last month, it's probably just an environment that's stable with a lot of volatility.
Is this a stable, tight labour market or a stable and loosening, somewhat, labour market?
I would say it's probably stable and slightly loosening. I don't think it's tightening, but we're in an environment where it's fine. Over the summer, you might start to see a little bit more loosening because that's when you tend to get people come into the labor market after they finish school. And it's an environment where it's very hard to absorb new entrants, especially those that are younger in nature and tend to be competing with AI.
Is the composition of these jobs positive? Does it matter? I mean, there is some broadening out, as Mike was saying, in some of the jobs that are being created. But really, again, the focus on healthcare and education, really significant. Also, we're not seeing the wage growth that people had expected. It's 0.2% our average hourly earnings month over month versus the 0.3% expected. Does that indicate that this won't be able to offer the wage kind of increase to offset consumers' ability to absorb the oil price shock?
Yeah, I mean, I think it tells you that it's in a labor market that is not hot or overheating. It's an environment where you're unlikely to get inflation coming out of the labor market, which is what tends to be durable inflation. So that allows the Fed to be a little bit more easy than would otherwise be the case, given where the data is. And by the way, when you're talking about the mix of hiring, our expectation is you'll start to see slightly more gains coming from the cyclical parts of the economy. Last year, that was held back by trade uncertainty. So this year, you'll probably see more gains coming out of leisure and hospitality and construction and manufacturing.
Do you think those gains will happen even though there is now the uncertainty of what to do with the oil price shock? I mean, last year it was the trade uncertainty. This year it's uncertainty around shipping of goods.
Yeah, I mean, that's certainly another sort of wrinkle in the story. This doesn't seem to be... Our base case is this doesn't last beyond another couple of weeks. If we're wrong there, then yes, that could start to filter into the labor market. But so far, it seems like an environment where, in fact, if you looked at the ISM most recently, the commentary was, we're concerned about the Iran shock, yet business activity is okay. And that seems to be the nature of the economy right now, is there are concerns about it, and it's a problem to some extent, but spending seems to be steady. The credit card data are all pretty good. Commentary from airline CEOs is quite positive. So it doesn't seem like it's really hurting the consumer yet. It could eventually, but provided this only lasts another couple of weeks, it shouldn't do too much damage.
The data we've seen this week validates this strength. It speaks to it. It reinforces it. The ADP number was strong. Jobless claims were low, saw momentum in retail sales going through March and hopefully into April as well and beyond. The numbers this week have been pretty decent.
Upside surprises, and this one just continues that trend to a greater degree. So have analysts been underestimating just how strong the U.S. economy was, stripping out the latest increase in oil prices?
It's a big upside surprise, 178. The median estimate in our survey was 65. Mike Collins, how encouraged are you by a stronger, much stronger than expected jobs report?
You know, all these jobs numbers, John, these monthly numbers are kind of have to be taken lightly, right? They're kind of a rounding error in terms of the context of the total size of the labor market. And I'm glad, Lisa, you've pointed out, I'm not that I want to be viewed as looking for chinks in the labor market armor, but, as economists, and Stephanie, right, this, we're trained to look at the hours worked, which is down, times the wages you make per hour, which was a downward surprise, right? You multiply those together, that's the amount of discretionary income people have to buy things. Those are down this month, right? And on top of that, people are spending a lot more at the pump than they were a month or two ago. That also hits the discretionary. I was looking at air flights the other day, and I was actually surprised how cheap they were and how many empty seats there were on the plane. So I think you're starting to see this whiff of demand destruction working its way through the economy. But that being said, the labor market, by most measures, looks good. It looks solid. It's weakening a little bit, but it's not falling off a cliff. And again, I think that puts the Fed in a tough position. My instinct is they should probably cut rates a lot over the next couple of years, and they may not be able to, right? Again, that's a difficult position for any central bank.
I think it's worth noting that at the moment, Mike, I don't know about others, but you couldn't pay me enough money to go to an airport over the last few weeks.
I think that the
right?
TSA laws
exactly.
have gotten
And that's part
better,
of the situation for sure.
Mike, I want to talk about this bond market move. It's not a huge move, but yields are higher. At the front end by 6 basis points, on 10s towards the longer end up by 4. Given everything you've just said, buddy, you're expecting those rate cuts, tons of them over the next 12 to 24 months. Are you a buyer here?
Yeah, I think this is a good opportunity in the bond market. I mentioned earlier, I'm not necessarily a buyer of equities and credit on these sell-offs. I'm more of a seller into these big rallies we've had over the last couple of days. But in the bond market, I think bonds are cheap, right? Equities, you could argue they're a little cheaper than they were. They're less rich than they were, a month or two ago. But bonds, I think in general, at least high quality government bonds around the world, and it's not just in the U.S. where we've been actually legging into the duration trade and adding, interest rate risk. I think it's a long-term strategic buy for sure.
Michael Collins, appreciate your time, sir. Thanks for making time for us this morning. Michael Collins there of PGIM Fixed Income on a jobs report that comes in much stronger than expected, delivering higher yields across the curve. And Mike Collins is looking the other way and looking to buy that back up in yields.
Yeah, he's multiplying the hours worked, which actually went down on average for each employee, times how much their wages are going up. And that is your discretionary income bucket, and it is going down. That said, the point that you were making earlier, the fact that we've seen upside surprise after upside surprise, a lot of people have underestimated the U.S. economy. So at what point do you take a look and say a good number is a good number? How do you sort of parse what is otherwise a very confusing backdrop?
You noted the surprise index earlier this week, the Citi surprise index. Where are we now? Super high.
We're at the highest level since late 2023. This is just giving you a sense of how negative people have been relative to the actual data that's been coming in. And people can say, but, and point to all of the reasons why it isn't that great. Nonetheless, you put it together, it looks like an economy that's pretty strong.
Stephanie, final word, final conclusion on this jobs report. Put it all together, because there are pockets where you can say this isn't great, hours worked, wages, other pockets where you can say this is fantastic, headline payrolls, unemployment.
The result is probably somewhere in between. And last month we had significant decline in jobs, and this month it was a big gain. We continue to get swung around by volatility in the data. And I think the important thing is to take a big step back and look at the trend that we've seen in the last couple of months. And it's a labor market that's fine. It's steady, certainly better than where we were last year, but it's not one that's overheating. So it's one where the Fed can wait and see how the inflation backdrop continues over the summer. Ultimately, I think they'll be able to be cutting later this year, because what you'll probably see is the unemployment rate rise steadily throughout the summer as you have some of those seasonal effects and younger people entering the labor force, harder for them to find a job. But right now, it's a wait-and-see backdrop with a labor market that is doing just fine.
Stephanie, good to see you. Stephanie Roth there of Wolfe Research. Looking at 178, you just get the sense that a lot of people watching the programme right now, because of the revisions we've seen over the last 12, 18, 24 months, they're mightily adjusting that number just down a touch from the 178 we've just seen.
Okay, to be fair, what do you do with this? Last month we got negative 92,000. Wow, that must be revised upward, right? No, it was revised downward to negative 133,000. Okay, but people were expecting 65,000 and it was 178,000. These numbers are sort of all over the place and don't give people real conviction that they have a sense of the path of
I'm
travel.
going to sound like a member of the FOMC, so forgive me. Forgive me.
I'm going to actually tape this and play it back to you, but carry on.
The totality of the data.
Ooh, look at this.
Last month, that number was not reinforced by the data we were seeing elsewhere. In fact, quite the opposite with that data. And last month, when we saw that big negative number, we talked about the weakness in healthcare because of the strikes. We talked about the weather impact in this as well. So I think you can park last month. And even if you want to park this month and push it to one side, the data elsewhere has continued to be decent. The ISM has continued to be strong. So if you look at the totality of the data right now, and this isn't a judgment on where the data is going to be 1 month, 2 months, 3 months out, because I don't know based on the shock in the Middle East. It's about the momentum we've got in this economy right now. Based on the totality of the data, it looks like this economy is doing okay.
When you look at the averages, and I'm glad that you pointed to the idea of the 3-month average change in non-farm payrolls being 68,000, that is still viewed as greater than the break-even rate needed to keep this economy on keel. So that is a positive figure.
Let's get you an update on that and our news worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Just recapping that strong jobs report. Non-farm payrolls coming in well above estimates for March, with 178,000 jobs added in the month versus estimates of 65,000. The unemployment rate ticking down to 4.3%, 0.1% lower than expectations. President Trump is proposing a $1.5 trillion defense budget paired with a 10% cut to domestic spending. The plan is tied to the war in Iran and sets up a sharp political fight in Congress, with Republicans split on deep cuts but likely backing those defense hikes. And astronauts are now on a precise path to the moon after NASA's Orion capsule fired its main engine in space. The Artemis 2 crew is set to fly by the lunar surface in the coming days and could set a record for the farthest humans have ever traveled. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for the update. Up next on the programme, we'll catch up with Aditya Bhave of Bank of America, breaking down the latest jobs data. And that jobs data, a stunning upside surprise. That conversation up next.
It's an economy where the labor market is largely stable. It's not picking up significantly this month. It's probably stable and slightly loosening. I don't think it's tightening, but we're in an environment where it's fine. Over the summer, you might start to see a little bit more loosening.
It's a fantastic jobs report. That was Stephanie Roth of Wolfe Research. Much, much better than expected. 178, the estimate 65. Equity futures down by 1/3%. Stocks are down and yields are higher. Can't get a break from this, can we? Bond yields up by 5 basis points. Call it 4 on 10s, up 5 on 2s. With us around the table, Aditya Bhave of Bank of America. Aditya, good morning.
Good morning.
Just frame this jobs report for us, because we're seeing a lot of volatility month to month. What's the trend? And look at the totality of the data. How much momentum does this economy have?
So let me give you 3 numbers that I think really stand out today. The first one is 4.256%. That was the unrounded unemployment rate. So we didn't just print a 4.3. We almost rounded down to 4.2. This was a big improvement, even if it's because of lower participation. That's like the key number that the Fed focuses on, right? Second, 35 months. So typically in a business cycle, once the unemployment rate bottoms out, you go into a recession at most 14 months later, typically within a month. This has been true every prior business cycle. This time around, it's been almost 3 years, 35 months since the unemployment rate bottomed out. It's up 80 basis points. That's it. So as much as I don't like saying this time is different, it really feels like this time is a little bit different. And then the third number that I would like to give you is 79,000, which I believe is the average for private payroll growth in the last 3 months. Let's not think about February as payback. Let's not think about March as payback for February. Feb was actually payback for Jan, right? January now got revised up. It's 160,000 non-farm payrolls. And so the minus 133 in Feb pays you back for that. Your 3-month average is still very, very strong.
A lot of the data is very strong. Yeah. The one pushback that actually really does resonate is that the average hourly earnings have not been increasing as much as people expected, and you aren't seeing the hours worked increasing. They're actually decreasing. At what point is that a sticking point, not just to the overall bull case, but to the fact that the K is widening that much more with the oil shock?
That's fair. That's a point of concern. So if you look at aggregate growth in income in March, it was probably close to zero. The thing about that, though, is that the Fed has been very consistent. You think about aggregate income growth as a proxy for consumer spending, right? Future consumer spending. The Fed has been very consistent about the idea that they have a labor mandate, they don't have a GDP mandate. That's what they said when they were hiking in 2022 with what was in real time a technical recession. That's what they said last year when they were cutting because the labor market was soft, but GDP was strong. So they're going to focus on labor, not the consumer, is my point.
Do you think then that this is going to decrease GDP even though the economy is doing okay, even though the labor market seems to be holding up?
This could be a headwind to consumer spending. Again, it's 1 month's worth of data. Wages typically lag a little bit, so maybe wages will pick up in coming months. But fourth quarter GDP came in less than expected. Potential for downward revisions. The first quarter is also looking somewhat soft. I think a lot of that is weather disruptions. It'll get paid back, but it's hard to deny that activity has been a bit softer than expected in the last few months. That said, the acceleration in labor is somewhat striking as well in the last couple of months.
Number one question, is this labor market strong enough to support higher prices in this economy?
That is absolutely the key question. I think it's going to support slightly higher prices. The question is how much higher. I don't think we're going to see an inflation spike like in 2022, precisely for the reason that you said. I mean, basically, the way I think about 2022 is you had huge supply disruptions, but you also needed demand to be strong enough to essentially hit that vertical part of the supply curve. I don't think we're going to be there right now. But we'll have to see. We're also going to have to see how big the supply disruptions are, not only in energy, but also, much more importantly, how much passes through to the core.
And how long it lasts. Aditya, it's good to see you. Thanks for making time for us. Aditya Bhave there of Bank of America on a much, much stronger jobs report than expected.
I love how he said, look, it's good. You look at it, it's good. People were talking about January being payback for December, and this isn't just payback, it's that much more. A lot of people coming to a similar conclusion.
We certainly want to see more of that. In just a moment, we'll have a conversation with the NEC Director, Kevin Hassett, Tchir of Academy Securities, Torsten Slok of Apollo, and the former New York Fed President, Bill Dudley. Reaction from the White House first, up next, right here on Bloomberg TV.
The market has been pretty resilient.
This has been extremely volatile, and I think investors don't really know what they're supposed to make of all of this.
In a 6-month window, I can see a lot of volatility.
Now we get whipsawed because the positioning gets really light and momentum unwinds.
The year ends up in a much stronger spot than we are right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures declining by just 1/3% on the S&P. On the Nasdaq, down by 0.4. In the bond market, yields higher by 5 basis points at the front end of the curve. 2's up to 385, 10's up by 4 to 434. Following this, a blowout jobs report. The headline number, 178,000. The estimate in our survey, the median, 65. Unemployment down to 4.3 from 4.4 and almost a 4.2 handle.
Yeah, which is a reason why we were just talking to Aditya Bhave of Bank of America. He said this is a great number, and he dismissed some of the questions around the wages not increasing as much as people expected, and saying, look, you could ultimately get a labor market that holds in, a U.S. economy that is resilient without necessarily a significant inflationary pop, even from higher oil prices.
One word for me, momentum. The momentum of the last week in the U.S. economy. Retail sales, better than expected. ADP, better than expected. Jobless claims, lower than expected. The payrolls report, much, much better than expected. That's momentum that's difficult to argue with, going into a big shock. in the Middle East.
And it explains why you are seeing companies engage in mergers and acquisitions, deal offerings. The reason why we're talking about big IPOs coming later this year, and you talk to people in the banking sector, they're all fires, all guns ablaze, and let's go. A lot of the companies and corporate executives see that momentum continuing, even if dampened on the margins from higher oil prices.
Big hour coming up this hour. In just a moment, we'll catch up with the NEC director, Kevin Hassett, reacting to the latest jobs data. Torsten Slok of Apollo expecting a Nike swoosh recovery for the economy, and the former New York Fed President Bill Dudley joining us later in the hour on the path ahead for interest rates. We begin this hour following a much stronger than expected jobs report. And I'm happy to say that joining us here on Bloomberg TV is the National Economic Council Director, Kevin Hassett, live from the White House. Director Hassett, welcome back to the program, sir, and happy Easter to you and your family for the long weekend. A blowout jobs number. How much momentum is in this economy?
Yeah, you mentioned the word momentum, and that was exactly when we were talking about today's number last night with the president. Momentum was really the key theme of the briefing that Pierre, the CEA chair, and I discussed with the president. The fact is that there's so much momentum because of all the positive policies, the deregulation, the low tax rates, and you're seeing all the positive stories about no tax on tips and no tax on overtime. I, by the way, was at a restaurant yesterday, and I asked all the waiters how much money they made on the no tax on tips, and the range was from $3,000 to $10,000, and they were all so happy. So that's like a positive momentum creating thing that I think if you have your eye on the horizon, as America's corporations do, absolutely explains why job markets are booming. And so I think that if you keep your eye on the horizon, if you understand the long-run growth, the golden age is coming because of our policies, then this jobs number makes complete sense. The final thing I want to say is I want to tip my cap to my former colleague in the Trump White House in the first term, Anna Wong, who's now the chief economist for you guys. You know, I always read everything she writes, but at the beginning of the week, she said almost exactly this is what's going to happen. And she was the only person in the universe that did it. I commend her because she's got a great model, and she got the number almost exactly right. And finally, in her report, she said, if you really want to wonder about momentum, you can also look at the 3-month moving average, because we had like that big blip down in the previous month. And she said with her really optimistic outlook, it was going to go up to 61,000 average per month, and it's actually closer to 68,000 now. And so it really is a very, very positive day for markets.
68 on the money, the 3-month average. Anna was looking for 150 headline today. We got 178. Bramo, do you think that Kevin might be popular in restaurants at the moment?
I think very much so. I think that he's trying to exploit that, trying to get some free onion rings.
Kevin, no doubt we've got momentum and lots of reasons for it. We've got the tax refunds starting to come through. The Fed had cut rates at the back end of last year. Some of the biggest companies on the planet are spending a lot of money. Those capex intentions are huge for the year ahead. How insulated do you think the U.S. economy is, given the shock in the Middle East and the reality that energy prices now are a lot higher than they were a few months ago?
Well, one thing is that the U.S. is really the engine that drives the global economy again. And we kind of lost that status, I think, under the previous administration. And so I know that there are starting to be some supply disruptions in the East and so on, but the U.S. is standing ready to export more to these countries, more refined product, more crude. And also, we've taken a number of steps to minimize the disruptions here in the U.S., doing things like waiving the Jones Act so that we could get U.S. gas and finished product over to the West Coast. And so I think that in the end, the strength of the U.S. economy is going to be something that's kind of like a safety net for Asia as they're dealing with the fact that they have to import all their oil. And so shocks, they're more sensitive to shocks.
They're experiencing real shortages. We've seen fuel rationing in places like Indonesia. Certain governments introduce 4-day weeks. No doubt we have abundant supply across much of this nation, with the exception of a couple of places. But we're still price takers in America. And Kevin, I wonder from your perspective, given the momentum we have, and given the higher prices in energy, just what is the prospect for broader price pressure picking up from here for the year ahead?
Well, what I would urge you guys to do, and you have the technical capability to do it, is something that I look at every day, is look at what the futures markets think. And also, if you look at the options markets, you can construct a sort of 95% confidence interval of what's possible with energy prices. And if you look at that, then it pretty much futures markets agree with President Trump that this is going to be a temporary disruption. And then the strength of the U.S. economy is going to basically be a bulwark for the global economy. And so I would suggest I keep a close eye on the futures markets. Forecasting these things is very difficult, but the futures markets have, basically prices going back towards normal over the summer, but there is a pretty wide 95% confidence interval.
There is a question, though, Kevin, how much you can really model out right now, given how quickly moving things are on the ground. And a lot of people who we speak to expect oil prices to remain higher for longer. We're looking right now at diesel prices at $5.53. We're looking at average gasoline prices at above $4. Can you still see 4% GDP growth this year if oil prices remain at these levels?
Yeah, absolutely. I don't think, as you saw with today's jobs report, that we should expect that people are going to have to revise their annual forecasts very much. And I think that the main reason for the U.S., and the main reason is that we're a much different economy than we were in the 1970s when we were so energy dependent. I do think that there will be some negative repercussions that'll be very short-lived in the Asian economies, and we expect that disruption to be over really, really soon. It's something the president has emphasized over and over, and emphasized again with me last night.
How much are you modeling, though, what happens if this goes on through June, through July, through August? I mean, how much do you have contingency plans for what type of levers you could pull to help support an economy that has enough momentum in it heading into this at a time when people already are cutting back around the margins? You can see this in certain discretionary spending types of surveys that are coming out in real time.
Our job is to prepare for every scenario, but to be realistic about what we expect. And what we expect with a high confidence is that what you're seeing in today's jobs market will continue, and that this situation in the Middle East will be over very shortly, as the president has said over and over. And then people can put their eyes back on the horizon and see that we're creating a golden age. But of course, we're very careful to think about what could be disrupted and what we could do to do something about it. And as an example, we found that some Asian economies were holding back jet fuel shipments to some of our airports on the West Coast. And so we waived the Jones Act to make sure that we could get some Gulf oil to the West Coast so that their airports could continue to run. There are little things like that all around the world that happen every day, and we've got people who are watching every single one of them to minimize the disruption.
How much are you pushing, Kevin, also to remove certain taxes on gasoline, on diesel, in order to also make it more affordable in the near future?
Well, I think that right now the focus is on finishing the job, and our strong belief is that if we do that, then we're going to get things back to normal very, very quickly. And don't forget, we're talking about the cost of what we're doing. The benefit is that we're hopefully ending the time when this really murderous country can cause turmoil throughout the Middle East. And if you think about that, then I'm sure that some of your Wall Street friends could give you some guesstimates today, but what's the higher risk premium that's capitalized into markets all around the world because of Iranian terrorism? How much more investment would there be in the Middle East if people aren't worried that the Iranians are going to be throwing rockets at them all the time? These are all long-run big positive effects, and if this ends shortly, then I think that you're going to see a recovery, even in the places that are currently most heavily burdened by this, because they're the ones who have been really suffering so much under the oppression of this country.
Kevin, can we finish on the war? And I don't expect you to talk about strategy and timelines. We've talked about that before. You wouldn't want to compromise the safety of our troops in the region at the moment. I'd like to finish on objectives and reopening the Strait of Hormuz, because some of the communication through the week has been slightly contradictory in the minds of some. That on the one hand, the president has said, open up the strait or else. And other days, the president has said, it's up to other people to open up the strait because they're more dependent on it. Where are we on that front at the moment? Is it the objective of the administration to reopen the Strait of Hormuz?
I'm going to continue to let the president to speak on that matter. I think that we are moving full speed ahead with our plans, and we believe that as we do that, things will return back to normal relatively quickly. But as far as talking about short-term policy, I'll let the president speak for himself.
Kevin, appreciate your time. and your thoughts. Have a wonderful weekend, sir. Thanks for making time for us. We appreciate it. Thank you. Kevin Hassett there, the National Economic Council Director, following a much, much better than expected jobs report for this country.
Yeah, and still seeing the U.S. economy on track for that 4% GDP. The assumption being that the conflict will end in the next 2 to 3 weeks. What that means, everyone is parsing over to understand the longer-term ramifications, both for commodity prices and for the persistence in some of the supply shocks that have become very physical and very real in a lot of places.
It's a word you're going to hear a lot, momentum. And the momentum we've got in this U.S. economy and the tailwinds behind us coming into 26. No doubt Torsten's going to talk about it in just a moment when we catch up with him. There is a lot of momentum. It's the question about price pressure that interests me, that if you believe there is lots of momentum in the economy right now, how vulnerable are we to broad-based price pressure? Now, in Director Hassett's mind, he's looking at the oil futures curve, and it does suggest a steep sell-off in crude prices through the next 12 months or so. Let's hope the market is right, and that we do get that decline, and once we get through this shock, things get back to normal. But certainly at the moment, given the potential for higher prices from here, that momentum supports that idea.
And if there is enough momentum, and if this does continue to be a more prolonged oil price shock, at what point are we also talking about a persistence in inflation? I was looking at the Cleveland nowcasting, inflation nowcasting, and we're looking at inflation in the first quarter, core PCE at 3.63%. That is moving in the wrong direction, even in the second quarter at about 3%. So we're still talking about an elevated rate, which leaves the Fed in a very difficult spot.
Just an update on the price action for you. Equity futures, trading closes in a few minutes' time. We're near session lows. We're down about 1/3 of 1%. Not too much drama there. In the bond market, we'll get about 3 more hours of trading. We'll trade until noon in fixed income for treasuries. Yields at the moment higher by 4 basis points. 2s at 384, 10s at 433. With an update on our news worldwide with that jobs report and more, Yahira joins us now. Hey, Yahira.
Exactly, John. Recapping the jobs report, non-farm payroll showing a strong upside surprise in March with 178,000 jobs added, well above estimates of 65,000. The unemployment rate ticked down to 4.3%, 0.1% lower than expectations. Iran is escalating attacks across Gulf energy sites, hitting facilities in Kuwait and the UAE, while Saudi Arabia intercepts drones. No casualties were reported, but fires did disrupt operations. President Trump threatening more strikes if Tehran refuses peace talks. And more details on one of those attacks. Abu Dhabi is suspending operations at its biggest natural gas processing facility after a fire. It's the second time operations at the project have been halted since the war in Iran started. The site is central to UAE gas supply and oil exports. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira later this hour. Up next, we'll catch up with Tchir of Academy Securities, saying the March jobs report was more strange than wrong. We'll get his thoughts on a blowout number in just a moment. Live from New York City this morning. Good morning.
There's so much momentum because of all the positive policies, the deregulation, the low tax rates, and you're seeing all the positive stories about no tax on tips and no tax on overtime. Absolutely explains why job markets are booming.
Difficult to argue that following the jobs report we just saw. That was the National Economic Council Director, Kevin Hassett, with reaction from the White House first, right here on Bloomberg TV. The number looks like this, 178. Came in at 8:30 Eastern Time about 47 minutes ago. The estimate was 65,000. The unemployment rate coming in at 4.3 and almost coming in at 4.2, down from 4.4.
Yeah, when you take a look at the 3-month average change in non-farm payrolls, this is what people are looking at. It was 68,000. When you take a look at change in private payrolls, that has also been increasing, I believe, at a significant pace. So you look at all of this, you start saying, okay, how strong is this labor market? Is it going to lead to wage growth? Is it going to lead to inflation? Or is it just going to sustain an economy at a solid footing amidst what could be a prolonged oil price shock?
The stock market firmly focused elsewhere. We just finished up stock trading this morning on equity futures, negative by about 0.3%. So no bounce here I think we bounced for about 2 seconds following that jobs report. The Nasdaq down by a third of 1%. Still trading as the bond market, yields higher by 4 or 5 basis points through the curve on 2s, 10s up by 3 or 4 basis points to 4.34.
Yeah, an expectation here that this allows the Fed to keep feeling like they are in a good place, at least in a good enough place not to have to do anything. Question on the longer term, whether this means that potentially this is an economy that could hang in there. Part of the confusion, the difficulty to trade this market and why some people have called it untradeable is there are so many questions about the longer term horizon based on what victory in the Middle East looks like amid a conflict that is causing physical shortages in large parts of the world when it comes to things like oil and gas and diesel and even questions around some of the other commodities like helium that go into semiconductors.
Lots of reaction through the next 40 minutes. We'll catch up with Torsten Slok of Apollo, the former New York Fed President Bill Dudley joining us in just a moment. Here's a take from Peter Tchir of Academy Securities writing, the job report was more strange than strong. Joining us now is Peter Tchir. Pete, welcome to the program, sir. Why more strange than strong?
Well, one, if you go back to the JOLTS data, which I like to look at, you had the hiring rate was actually the lowest it's been since COVID. That kind of reached the post-COVID lows. And you also had the quits rate very, very low. And quits rate to me is kind of a crowdsourced bit of data. You had really big revisions to prior months. You've had government shutdowns. So I think, as Lisa said, the 3-month is 68,000. That makes some sense. I think I'm not going to get too excited that we had this super great jobs number. And I'm not going to get too worried that the prior month was super horrible. I think we're having a lot of data calculation and collection issues, and it's coming through in the numbers when they're printed.
Pete, away from the payrolls report, though, momentum. It's a word that's come up repeatedly. You heard it from the White House just moments ago. ADP was strong, ISM was strong, jobless claims were strong, retail sales was better than expected. It's hard to argue that this economy doesn't have momentum. Can you make that argument?
Yeah, I think there is some positive momentum. Again, a lot of this, though, right, prices have gone up, affordability is high, so how much of this is people being forced to spend more for the same basket of goods they were buying? And I think it's very hard to measure anything right now. It's been very volatile. The conflict in Iran has kind of put a damper on how do you measure things properly? What is permanent? What's temporary? What can people live through? What jobs are being created by this? What jobs are at risk? So I think we're still in this really wait and see to see how this conflict plays out, which, as Kevin Hassett said, could be very strong. I think our best case is we proceed and finish this to the end, where the Iranian regime really changes and resembles something that fits into the global economy much better.
Given that, and I don't want to oversimplify it, but how do you put all the pieces together of a puzzle to answer the key question, which is, could this shock be a greater hit to growth expectations or a greater boost to inflation longer term?
So I'm looking at trying to parse this into parts of the world and areas that I think will do well, kind of whether we get a quick resolution or a longer term resolution. I think you're going to see Europe actually spend a lot more on infrastructure, energy infrastructure, and building out their economy again, right? They kind of seeded all manufacturing. So I look to that as an area. I think we're going to see a lot of activity with the U.S. helping in Central and South America, right? It's just a natural place. Yes, if we have a successful completion of the war, the Middle East will do well. But again, I think our focus is going to be really much Central South America. So I'm looking at investing there. And I still want to get back to, the rare earths, the critical minerals, the process refining, the smelting required to remain independent. You're kind of going on a theme almost of calling it vertically integrated nations. So every nation doing a little bit more of their own. And those are the investments I want to make right now.
Given the fact that a lot of people are investing in the physical world, how much money is getting sucked away from the government bond space in terms of the buyer pace for some of the debt that's going to be incurred to pay for some of this, right? I just wonder if your faith in the physical world and the resiliency and some of the themes that a lot of companies and countries have been harping on, how much that comes at the expense of money flowing into financial assets like bonds that have typically been a buffer against any kind of volatility and economic growth.
Yeah, I think you're going to see a steady kind of headwinds against bonds rallying too much. And it's going to be countries being forced to sell their bond holdings to raise money to buy oil, to buy the defense stocks, and then the issuance of more debt. So I think there's a stubborn headwind facing treasury yields. And that's not just here, it's globally, right? It's a global market. And again, as each country kind of focuses on their own issues, their own needs, I think you're going to see less demand for U.S. treasuries, partly because every country probably has to spend a little bit more than they were planning on right now.
Pete, I often listen to your podcast now. It's fantastic, by the way. I've been tracking that now.
Thank you, John.
Was listening to the last week. Can't guarantee you'll get bought by OpenAI, unlike some, but it's fantastic. Pete, going through that podcast, you lean on a lot of military experience, and that sets up the conversation for you and the team to talk about markets. Can we set aside the communication from government sources over the last week? Because some of it's been very confusing. When your military personnel, your veterans in the team, focused on military posture and what's happening and developing there, the troops, the assets moving into the region, where do they think this is heading?
So that's a great question. One bunch of our military people have said, you always want to pay very close attention at the press briefings to what the military say. They're objective. They are trying to give what they can, assess without giving away information. The flip side is both the president and the secretary of war, they are political figures. So they have to put a political spin on it. So I'm going to try and stick to what we see as the military. We are building up so that we have the ability to do more. Now, some people say we have to use it once we put there. No, this actually, just having it there applies additional leverage on Iran, right? It's hard to say, oh, we might do something with troops if the troops aren't there. So some of this is going to be posturing to push. I think when we talk to our military experts, the view is that the single best thing the U.S. can do is proceed all the way to the finish. And we have to get rid of the, Iran's ability to do anything on the nuclear side, right? The assessment is if there's any country in the world that would take nuclear weapons if they had them and use them, it is Iran. So I think what we would like to see is going forward and finishing this job, getting to the point that you truly have a regime that looks very, very different in Iran, is willing to work with the rest of the world, and we can all breathe a sigh of relief. Whether we get there or not is a question. I think that is a matter of the president selling the war better than he has even to this day to the American people, and allowing the military to complete its job, which is going to take time, and 2 to 3 weeks may even be short on that. But that would be the single best outcome.
Pete, I've got 30 seconds left. The French president does not think we can reopen the Strait of Hormuz through military means. Does your team disagree?
I think we would disagree, though. One, we are very careful in talking about this. It is the ability for commercial ships to transit the strait, or better yet, the willingness of commercial ships to transit the strait. So we have to create a condition where captains and crews on these ships say, you know what, I feel comfortable, I feel safe enough to go through. That will take a period of time. It will take shows of force, shows of display. It probably requires some sort of cooperation. It is interesting yesterday that Oman was on record trying to do something. Technically, Oman controls many of those waters in theory. So I think there is this possibility, and we need to see a coalition kind of build to get that. Again, I'm not sure we can get this in a 2 to 3 week time frame, but I think we would all like to see this proceed to a proper conclusion. And the flip side is the worst case is we walk away and leave this in disarray. That would be, I think, horrible for markets. Even if we popped on day one because of that, this really should be seen to completion.
Pete, thank you, sir. Peter Tchir there of Academy Securities, a company absolutely filled with military experience.
And you could hear that from the podcast where they
fantastic,
line up all of their generals and admirals and talk about the actual what's going on the ground.
Real hard line experience there.
Exactly.
What's happening on the front lines. Let's give an update on what's happening next with Torsten Slok of Apollo, looking for a Nike swoosh recovery in this economy.
The U.S. is really the engine that drives the global economy again. And what we expect with a high confidence is that what you're seeing in today's jobs market will continue, and that this situation in the Middle East will be over very shortly. And then people can put their eyes back on the horizon and see that we're creating a golden age.
That was the National Economic Council Director Kevin Hassett, sounding quite happy given the jobs number we just saw in this country, a blowout payrolls figure. The equity futures trading has finished, it's wrapped up, and equity futures looked like this at the close. We're down by 0.3% on the S&P, on the Nasdaq down by 0.3%, also on the Russell small caps underperforming here by 0.5%. Given this development in the bond market, which is high yields, up by 5 basis points on 2s to 385, 10s at 435, yields inching higher off the back of a much, much stronger than expected jobs report.
We've been asking all morning, at what point does the momentum in the U.S. economy lead inflation to be higher for longer? Still to this day, given the move that we're seeing in bond markets, yes, you are seeing yields a little bit higher, but it isn't a massive move based on 178,000 jobs getting created and the unemployment rate falling almost is at 4.2%, but to 4.3% rounded up. This indicates that people still don't believe this is going to be an inflationary shock, even with the momentum in the labor market.
Given the negative supply shock in this economy, in this labour market, 3-month average of 68K, pretty solid. That's a pretty strong number.
Yeah, and there's no way you can really slice this and say it was a bad number. So even if people are looking at this and saying it's a Rorschach test, you could take a look at hours worked, or you could take a look at wages not rising as much as people expected. It's a good number. It's a good number pretty much any way you slice it.
Mike McKee's been slicing it up. He joins us now for more. Good morning, Mike. What do you see?
Well, I have to take the other side from Lisa just to be obnoxious this morning. I was thinking about the people who write into us regularly after these reports, especially the category of folks who say the Fed's got to cut, the Fed's got to cut. There are reasons why they could hang a little bit on the data in here. Now, we did have an almost 0.2 drop in the unemployment rate. That was quite remarkable, and that's the kind of thing that the Fed is looking at. But what caused that was a big drop in the civilian labor force, 396,000. Labor force is now lower than at any point since December of 2024. So we've lost a lot of workers. Maybe that's the president's immigration policies. But we also saw unemployment drop by 332,000. That's not the kind of thing that we had been seeing up to this point in the job creation numbers. And when I'm saying 332,000, that's the household survey. The household survey also showed a drop in employment of 64,000. So there are people who think the household survey is better, and they hang their arguments on that. That might be what they're looking at. And you could also look at the calendar and say these reports are based on the pay period that includes the 12th of the month, and that was pretty early in March this year. So the war had just gotten underway. And then finally, the question you mentioned about inflation, Lisa, I looked, that week ended, the week of the 12th ended with gasoline prices at $3.67. Now we're at $4.09. So maybe people's views are changing a little bit.
Mike McKee, good try. Mike McKee, thank you, sir. Breaking down the jobs report. Are you converted?
Look, I can point to a lot of holes in this. I'm not accused of being overly optimistic. Please, no one worry about that.
That's never happened.
I don't think anyone's saying, God, Rosie misses. Why are you just always trying to paint things wonderfully? I'm just saying this is a good number, and I think that pretty much when you take a look at the average, it's solid.
At the headline, it is what it is. Torsten Slok of Apollo says the following: we expect to see a Nike swoosh recovery for the economy over the coming quarters. Torsten joins us now. Torsten, good morning.
Morning.
Before we get to that, your reaction to that jobs report at 8:30?
Well, it is absolutely correct, of course. Looking at it from only last month of what happened in February and March, it does look more volatile. But exactly the 3-month average at 68,000, that's a pretty strong number. In particular, when the Fed just yesterday published a research note saying that the new break-even number is 10,000. The timing of that note and that number on its own, it tells you that 68 is a blowout number over the last several months. So the momentum in the economy is really quite strong at the moment.
The tailwinds are real. We've had rate cuts. We're getting tax refunds. You've got all this capex coming from major companies in this country. How supportive of that will this be, of this economy, in the face of a real energy shock coming out of the Middle East?
It will continue to be supportive and drive growth forward. Last year, the narrative was all about headwinds coming from the trade war. The Nike swoosh bottom that we're standing at the moment is all about the 3 tailwinds that are now emerging. We have a lot of spending on AI, a lot of spending on data centers, a lot of spending on energy associated with AI. We also have productivity gains from AI. We also have on top of that an industrial renaissance. There's a huge political desire to bring back production of everything from pharmaceuticals to semiconductors, of course also to defense. That's also an engine of growth. And most importantly, as you mentioned, John, we also have the one big beautiful bill. Last year, on average, tax refunds was around $3,000. We calculate that this year, on average, tax refunds will be around $4,000. Why is that the case? Because the one big beautiful bill lowered taxes retroactively starting January 1, 2025. That means that we have all paid too much in taxes when we go and file our taxes here on April the 15th. That means over the next several months, consumer spending should continue to see strong tailwinds. That's what we're seeing in retail sales. That's what you see in your weekly data from Redbook, same-store retail sales. That's what you see in TSA travel data. That's what you see in the daily data for travel across the board. So the conclusion is there is a lot of momentum in this economy because of AI spending, because of the industrial renaissance, and because of the one big beautiful bill.
This momentum just smack dab ran into what we're seeing that started in March and has continued with this, which is the conflict in Iran, the closure of the Strait of Hormuz, and higher commodity prices more broadly. Most people who come on the show say it's both an inflation shock and a growth shock, but they think that the growth shock is going to be a more significant outcome. It seems like you disagree, and that based on all of that momentum, you'd see inflation as the bigger shock. Is that right?
Absolutely, because if you look at the incoming data for the last month or so, while this conflict has lasted, if you look at the daily data for how many people travel on airplanes, it's still strong. If you look at the weekly data for hotel demand, occupancy rates, the daily rate, RevPAR, also very strong. If you look at the weekly data for retail sales, also very strong. There's even weekly data also for a wide range of other indicators when it comes to credit cards, also strong. So yes, there may be some demand destruction, but the key conclusion now is we're just not seeing that yet. So if that's the case, all the inflationary pressures that come from, also let's not forget, trade war. If you have goods ex autos have also been going up. You also have, of course, immigration restrictions is also inflationary. And now you have some oil price shock and a strong economy. The risk is that we will continue to see inflation stay higher for longer. And because of that, rates are likely to also going to stay higher for longer. Let's not forget, the first Fed cut as we speak is now in October of 2027. That's like far, far out in the future. The market is not expecting that rates are going to come down anytime soon.
Torsten Slok of Apollo is going to be sticking with us. Let's bring in Bill Dudley, the former New York Fed president. He joins us now for more. Bill, you were following what Torsten had to say about the U.S. economy. Does this Federal Reserve have the luxury of waiting and doing nothing through the next several months?
I think it's not a luxury, it's a necessity, because the uncertainty about how the war is going to be resolved and how high energy prices are going to be and how long they're going to stay elevated is still highly uncertain. And to the point that you raised earlier, this is both a shock to growth and a shock to inflation. So the Fed is back where they were, a year ago, where they were worried about both sides of their mandate. And then as we went through 2025, they became less worried about inflation and they became less worried about growth. But now I think they're now worried about both. And so I think in the current environment, they're just going to sit on their hands for quite some time.
That actually is a refreshing outcome for some in markets. Just a couple of weeks ago, people were worried about rate hikes at the Federal Reserve, and that was the outcome that people thought was unsustainable. Now the idea that Torsten Slok was just talking about no rate cuts until October 2027 is thought of as palatable. Do you think that a rate hike could still be on the table based on the heat in the economy that we've seen across a number of metrics?
Well, I think the Fed is inclined to look through price shocks that they view as temporary. That's their sort of going in proposition. But at the end of the day, inflation expectations really matter. And inflation expectations depend in part on how the Fed behaves. So let's imagine that the Fed said, we're just going to look through the oil price shock and cut rates today. Then maybe inflation expectations wouldn't stay well anchored, and then the Federal Reserve would have a problem on their end. So I think how the Fed is thinking about it is inflation expectations depend in part on how we behave, and the best way to behave right now is to do nothing until we can be more certain about which risk is the predominant risk at the current time.
So, Bill, just to make sure that I understand, you're saying that should break-even rates start to creep higher, or if surveys started to show that people were expecting inflation to remain entrenched, that this Federal Reserve would have an incentive to even talk about rate hikes, let alone actually do them, just to bring things into submission?
Well, I think if inflation expectations become unanchored, then the story changes pretty dramatically. I mean, the news so far is there's no real sign of inflation expectations becoming unanchored. You look at break-even inflation, five-year forwards, they're actually very, very low. If you look at the household expectations surveys that we've had so far, long-term inflation expectations are still well anchored. But remember, the energy shock, we don't really still know how big it's going to be or how long it's going to last. I mean, every day that the Strait is blocked, it's another 10 million barrels a day that are lost to the global economy. And so the peak in oil and natural gas prices remains to be determined.
And Bill, in terms of your thinking about the research piece that came out yesterday, where the Fed is now saying, and I know there's a number of different research pieces coming out all the time about this, but specifically saying the day before the employment report that they now think the break-even rate for non-farm payrolls is less than 10,000, as it said. What's your thoughts going into the process around them publishing that? And do you think this has any significance? Or it's pretty important that they are also now saying, like many on Wall Street, that maybe the break-even rate is really moving down closer to zero?
Well, I think the break-even rate has fallen sharply. I mean, if you crush the amount of people that can come into the United States and the population is aging, baby boom generation is retiring, so then labor force growth is going to be pretty close to zero. And if labor force is pretty close to zero, then payroll growth needs to be pretty close to zero to keep the unemployment rate stable. So I think this is something that is absolutely right. I mean, so we sort of have a funny a situation compared to a couple of years ago where the labor market's isn't very vibrant, But if it were vibrant, the Federal Reserve would actually have a problem because the unemployment rate would be screaming lower.
Bill, I remember spending some time with you and Mohammed coming out of the pandemic, and it certainly wasn't consensus to say what you were saying at the time. And you were talking about the prospect for much higher inflation, it becoming a problem. And I still remember you saying that the Fed could take interest rates to 5%, and we were near zero at the time, and it sounded insane. And you were right, sir. What do you think people are underestimating this time around? I'm not suggesting this is 2022. I just want to understand where you are on 26 and what we might be underestimating.
I think the war is the biggest risk. Opening up the Strait is really, it's critically important to how high energy prices go. And, I think the markets are still, underestimating that risk. They sort of assume that the war is going to be wrapped up relatively quickly. The oil is going to flow. And if that could be right, but there's definitely a tail risk that this whole thing is going to drag out much longer than people anticipate.
Bill, it's good to see you. Thanks for making time for us, as always. William Dudley there, the former New York Fed president, on the risks emerging in the Middle East.
Yeah, and if that does go for a longer period of time, how much is it an inflation shock and how much is it a growth shock? I mean, it gets back to the same story that we've been talking to all morning in the key debate of how resilient is the economy to absorb price increases by consumers. I'll tell you what worries me.
Sure.
Because clearly I have a worry.
There's got to be something.
My significant worry is if the U.S. economy is maintaining itself and you have the lower end of the K, if you have lower income and middle income consumers that are feeling the hit from higher prices that much more, they're not seeing significant wage gains, and the economy keeps chugging along, and that K widens out that much more, that is a very painful situation for a lot of households. And that seems like a likely outcome should this go on for a longer period of time.
That would be painful, with gasoline prices at $4 and climbing and north of those levels in some places across this country. The conflict for me, and we've talked about this tension all week, is the shift in the consensus view. The consensus view at the start of the year was we get a cyclical rebound for all the reasons Torsten describes. That was the consensus view. The consensus view now is that this economy isn't strong enough to generate second-order inflationary effects. I think there's some real tension in that. Torsten, would you agree?
Absolutely. If you type ECFC, go on your Bloomberg screen, you will see that the consensus for the rest of this year expects inflation to basically be above 3 by the end of the year. That's not good because the Fed's target is that it should be 2, and that tells you that if inflation is going to be more sticky, and we now have more uncertainty about oil prices creating additional impetus to the upside for inflation, that does indeed create a very, very uncomfortable situation for the Fed.
Torsten, you're going to stick with us, I'm happy to say. Let's get you an update on news worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Recapping our top story, the jobs report. Non-farm payroll showing a strong upside surprise in March with 178,000 jobs added, well above estimates of 65,000. The unemployment rate ticking down to 4.3%, a 0.1% lower than expectations. President Trump is proposing a $1.5 trillion defense budget, pairing it with a 10% cut to domestic spending. The plan is tied to the Iran war and sets up a sharp political fight in Congress ahead of the midterms, with Republicans split on deep cuts but likely backing those defense hikes. And SpaceX is testing a $2 trillion IPO valuation ahead of investor roadshows, potentially making it the biggest listing ever. The Elon Musk-led company could raise up to $75 billion as early as June, vaulting it past Tesla and Meta in size. That's your Bloomberg brief. John?
Yahira, thank you, and thanks for this morning. This is really the Jim Zelter argument over at Apollo, your good friend and colleague, which is that capital markets are still wide open. We're talking about all these risks, and they are real risks, and I'm not underestimating those at all. We talked about the seriousness of them over the last month. But the fact is that we could see some of the biggest IPOs ever in this country over the next several months, and not just one, but maybe 2 or 3.
Yeah, we're talking about Anthropic, OpenAI, we're talking about XAI, and this comes after the biggest month, the biggest quarter for global M&A ever. So that really highlights just how wide open capital markets
Lots of debt supply as well, Abramowicz.
Yeah,
It's been across the board. Up next, we'll set you up for the week ahead. Plus, we'll get you more. A final word from Apollo's Torsten Slok.
right now the focus is on finishing the job. How much more investment will there be in the Middle East if people aren't worried that the Iranians are going to be throwing rockets at them all the time? These are all long-run big positive effects, and if this ends shortly, then I think that you're going to see a recovery, even in the places that are currently most heavily burdened by this.
In the meantime, there's a real energy shock to deal with. That was the National Economic Council Director, Kevin Hassett, following a much better than expected jobs report in this country. Some real momentum, some signs of that in the US economy. Equity futures stopped trading about 35 minutes ago at 9:15 Eastern Time. They closed lower by about 0.3% on the S&P. On NASDAQ 100 futures down by 1/3% also. You get a few more hours of trading in treasuries. Yields are higher by 5 basis points at the front end of the curve. The 2-year up to 384, the 10-year up to 435. No trading in crude today, but some disruptions once again. Bramo, overnight.
Yeah, in Kuwait in particular, to a plant over there, also an attack on a desalination plant. So again, real concerns about civilian infrastructure. It is such a strange moment. How much does the labor market data count, given A, the fluctuations, and B, that it's backward looking before the shock? People are saying it does count. It shows momentum.
Let's get to the data for the next week. Your trading diary looks like this on Monday. ISM services data on Wednesday. The Fed minutes, some details of an interesting last meeting on Thursday, another round of jobless claims, and on Friday, CPI inflation data. Inflation data carries some extra weight over the next few months for sure.
How much will it be the priority right now for a Fed since the labor market picture has been checked off? It looks pretty good. You actually saw the unemployment rate come down. Okay, over to you, CPI. How much is it increasing? I understand that they don't target headline CPI, but it goes into inflation expectations longer term, which is very much something that's on the radar of this Fed.
This data point feels like the odd one out. It dropped just moments ago from S&P. US services PMI falling to a 3-year low, contraction rate, 49.8.
Yeah, and seeing the composite PMI coming in also at the lowest since 2023. What do we do with that? I'm not sure. We're looking at it, trying to understand where it fits in. It is an aberration relative to the upside surprises. Nonetheless, speaks to potentially, if you're going to create a narrative to one data point, which is what I'm about to do, but you shouldn't do, is that maybe people are pushing back on services.
Torsten Slok of Apart with us around the table for a final word. It was a good attempt.
Thanks.
Feels like the odd one out, that data point, doesn't it?
Absolutely, but I mean, if the conversation from the textbook perspective, when you have an oil price shock, we all sit and say, oh, that's stagflationary, that's stagflationary. But let's think about what this number and this week's numbers have told us. We got very strong ISM, we got very strong retail sales, we strong jobless claims, now strong non-farm payrolls. There is no sign of demand destruction. If anything, this is not stagflationary. This is pointing more towards overheating. And that's why the key worry in markets should be not so much what's happening with growth, because this week we were just told that growth is actually okay. It really more is to worry about, well, if growth is okay, because of this momentum coming from AI spending, industrial renaissance, and one big beautiful bill, the worry should be, as Lisa was saying, that we should begin to worry about that maybe the upside to inflation is still here.
Give me a number. Give me a range. What kind of numbers should we be thinking about for inflation?
Well, the problem is that inflation, of course, on the headline is now about to go up. The Fed's model, this shock alone, will lift inflation by 0.7 percentage points. Core inflation will only go up by 0.1. But the challenge is that we still have in the background that core goods ex-autos are going up. We still have restrictions on immigration, putting some upward pressure on wage inflation. Yes, it was a little bit weaker today, but it still is at 3.5%, still very strong average hourly earnings relative to where we were 6 years ago. So the short answer to your question is I think the risk is now that there's upward momentum, not only in headline, but also in core inflation. So we are going to stick around 3% for the next 6 months because of this combination of shocks.
You talk about the 3 pillars of this growth momentum, the AI spending, industrial renaissance, and the one big beautiful bill. At what point do higher yields, higher inflation constrain the capital market story that is underpinning both the AI spending and the industrial renaissance?
Yeah, what's unique about that question is that 2 of these forces are really not that sensitive to what interest rates are doing. Namely, AI spending will happen no matter what. We're in the midst of an AI revolution. So no matter what the Fed funds rate is going up or down, there will be tons of investment in AI. Likewise, when it comes to industrial renaissance, this is a political desire to bring back production of all kinds of things, from pharmaceuticals to everything in defense to everything going on across the board in semiconductors. That's also not so much a function of what interest rates are doing. So in that sense, from a transmission mechanism perspective, the sensitivity to interest rates is really not high when it comes to AI spending and the industrial renaissance. And the one big beautiful bill is definitely not sensitive to interest rates at all. So the risks are that the economy is just getting better and better over the next several quarters because these forces are no longer just as sensitive as they used to be to the Fed hiking rates.
So could we see an economy that continues to grow even as we see a credit cycle take place, where some of the weaker hands that are still out there get shaken out because they cannot exist with these rates and this rate of inflation, and they have not had to face it in real terms because they've had debt that's been termed out?
I totally agree, because the challenge now is in credit. That in credit, there is a spectrum of what is your coverage ratio, meaning what is your sensitivity to interest rates staying higher. And companies that have low coverage ratios, companies that have no earnings, no revenue, no cash flow, of course, they're going to continue to struggle when rates are higher for longer. So that means that in credit, the most prime example, of course, is software. Those businesses that have no earnings will continue to not do well, whereas high quality credit, those companies that actually have earnings, that are able to pay the debt servicing cost, they should continue to do well. And that's exactly the shakeout that we're seeing. The overall default rate for high yield loans is going down, but there are certainly some mini cycles going on in those parts of credit that do have lower coverage ratios.
Torsten, this was a clinic, and we appreciate your time. Thanks for making time for us. Torsten Slok there of Apollo on the risk to inflation, not the risk to growth in the US. And I wonder how much of an island the United States is right now, given the pain we're seeing elsewhere in the global economy.
Very much of an island. I mean, everybody was talking about how this would be the year of broadening out, of diversifying regions in terms of the performance. What you're seeing right now is suddenly a mass and violent rethink of that, with a sort of flood back into U.S. assets. How isolated can the U.S. be, and how resilient can it be, given the fact that we do have a lot of momentum in the economy at the same time that the price shock could be significant?
The president suggesting this operation, this war, as many people call it, will go another 2 to 3 weeks. We're already seeing shortages across Asia. You can see how painful it is in physical markets right now, and you can see where the shortages will show up next. It's not going to be great if this continues over the next several weeks.
Prices could go a lot higher, and this is what we talk about with all the commodity strategists who come on. And honestly, they need a vacation. Please, if you're a commodity strategist, I imagine you need to sleep in, have a stiff one tonight. Good luck.
You advising people drink?
No, stiff one of tea.
Oh, okay, of course, yes. A strong brew.
A strong brew.
Yes, of course. Sounded so British. Whereas Jim Zalta said, what was it? Take a walk.
Take a walk.
Take a walk.
Drink a strong brew.
There you go. What a jobs number. 178,000. The SMNR survey, 65K. Coming up on Monday on Bloomberg TV, Cameron Dawson of New Edge Wealth, Matt Miskin of John Hancock, Jason Thomas of Carlisle, Kayla Cedar of State Street. For all of you at home, thank you for choosing Bloomberg TV. To those who celebrate, have a blessed weekend and a very happy Easter. From New York City, this was Bloomberg Surveillance.